A very good morning, friends. A warm welcome to all of you. I hope you've been continuously revising what we have done in financial instruments. Things are getting a little technical, but I think getting a very interesting phase as well, as it is one of the very important standards from the examination point of view. We invariably get a question on financial instruments. So I would, say that you should keep revising the standard as well. There are a lot of technical but very interesting issues, as I said, at the same time. So I guess, first of all, what we're going to do, I gave you some MCQs to try in the previous class, though I think I got a couple of answers in the previous session only. But I think I'm just going to formally discuss the questions with you today before we take the journey forward. So I think my very first question, rather the first three questions, was based on the treatment of the TC, that is the transaction cost. So the first question is that if you're looking at a financial asset or you're looking at a financial liability and it is supposed to be measured at FVTPL, then I made a statement that the entire TC is immediately taken to the profit and loss account. And that is absolutely true, because in terms of FVTPL, that's the only exception where the value of the financial asset or liability is not adjusted. So this is absolutely correct. Okay, wonderful indeed. Good morning, Soham. Good morning, Marini. So I think let's go to the next one. The second question, what we are given is that there is a TC, a transaction cost which relates to a financial asset measured at FPT-OCI. Just to recall, there is no concept as far as FPT-OCI is concerned for a financial liability. Financial liabilities would be measured only at AC or at FPTPL. So I've just taken that financial assets are measured at FPT-OCI NR. So in this particular case, at the year end, when you consider the fair value change, the fair value change along with the TC enters the other comprehensive income. And I would say it doesn't get recycled to the profit and loss account as well, because whatever goes in the OCI, is taken to the tab number 3 of SOCI. And of course, from there, it gets transferred to the tab number 2, retained earnings at the time of derecognition. So indirectly, we can say that this TC also enters the other comprehensive income. So this statement is also absolutely true in nature. And I think that's the right answer. That's right, Nidhi. And I think I'm getting a couple of answers. Good morning, Rashmi. And then we gave the third question to you on a TC, that there is a financial asset which is measured at FPT-OCI-R. Now, when you're looking at a financial asset, financial liability again is not measured at FPT-OCI-R. Now, the difference between NR and R is the concept of annual recycling in case of TC. So it says it goes to the OCI at the year end, because when you go to compare the change in the fair value, it enters the other comprehensive income. But thereafter, we need to make an annual transfer from the OCI to the profit and loss account. So this TC, a portion of it will get transferred, or you can say recycled to the profit and loss account at the end of each year. So this statement is also absolutely true. So all three statements relating to TC, absolutely true. Then I gave you the fourth one, that TC, if it relates to a financial asset measured at amortized cost, it gets reduced from the financial asset value. And TC, in terms of the number 5, in terms of financial liability, is added. I intentionally took a little swap in terms of the fourth and the fifth point. Now, TC in terms of FA is added and TC in terms of FL is reduced. And of course, it immediately triggers the need of calculating the effective interest rate. Because when you calculated the fair value of the asset and liability, you would have taken a particular discounting rate. Now, since the TC has got adjusted to the value of the asset and liability, you cannot use the same discounting rate for the purposes of unwinding in the ledger. Remember, anytime you do any such thing, this is going to be a golden rule that in terms of amortized cost accounting, if you make any adjustments to the asset or liability value, naturally the discount rate which is used to calculate the fair value cannot be used in the ledger account for unwinding. It'll immediately trigger the need of calculating EIR. So fourth and the fifth one is both false in nature. And I think that's rightly given. That's right, Shailendra. That's right, Nidhi. Wonderful. That's right, Mani. Great. Wonderful indeed. So I think that takes care of the inputs in terms of the MCQ questions. Okay. Now I am going to take the journey forward. And I think what I need to do, it might take me 5 minutes, but I think I want to prove something to you, because I think this concept of TC needs a little more clarity. So I want to spend a little 5 minutes, giving you the amortized cost, especially that how does this TC gets treated. So what do you say? Is it a good idea spending a little 5 minutes with you on this area? I think yes. So let me do one thing. Let me just, I think, take you to a small little example so that I can illustrate that what is exactly happening in terms of TC for AC specifically, because this is something which you're going to see in a lot of questions to come. So I think let's start the journey. So let me take a very simple example, first of all, relating to transaction cost. And this is in a category, let's say we're looking at a financial asset, which is measured at amortized cost. Now let's consider this example twice. Number one, I'm considering that I invested, let's say 100 rupee. The transaction value and the fair value is, let's say, equal, and the contracted rate and the market rate is the same, let's say at the rate of 10%. And let me consider a time span of 3 years. Now, watch this carefully. This particular example is going to build up your concept very well. I put the facts again. I'm looking at a financial asset which is measured at EC. And I've considered that you've invested 100, which is the transaction value and the fair value as well. And the contracted rate and the market rate is 10% with a span of 3 years. Right now, I'm considering that there is no transaction cost. Okay, let me ask you a very simple question. Let's say, for example, if I were to prepare a ledger account, can I outrightly say that the finance income each year is going to be 10%? Can I comfortably say that the EIR is going to be 10%? What do you say? Considering that your contracted rate and the market rate is 10%, can I very conveniently say that the effective rate of interest is also going to be 10% itself? Do you vouch me for that? And I think that's rightly said. Great. So that means if I were to calculate the finance income for each of these years, can I say it's going to be 10 rupees every year end? You would unwind the interest income at the rate of 10% and the same amount would be received. Just to give you clarity of thought, let's say if I make a ledger account for the financial asset, then every year the position would look like this. You make an investment financial asset to bank, that is with the fair value 100, incidentally also the transaction value. You unwind the 10% discount, there is 10. You also receive the same figure by bank at the end of each year. So this is the finance income based on EIR, and this is the bank figure which is based on the contracted rate, and you get the balance CD as 100, and this remains the same for each of these years. So can I say the total finance income which I'm going to get at the end of each year, the sum total is going to be 30. I hope I am pretty clear on the picture. So we can very conveniently say that the TC is not there. So my finance income at each year is 10 rupee. So we get a total finance income of 30. Okay. Now what I'm going to do, I'm going to make a slight little change in this particular question. And in the same example, I'm going to insert my transaction cost as well. Let's consider the transaction cost is 5 rupees in the same case. Now the question arises that when you make your financial asset ledger account, Will I be able to record the figure at 100? Of course not. Can I say I would add the transaction cost to the financial asset value and I would record this at 105? Now, let me ask you, would I be able to unwind my finance income at the rate of 10%? What do you say? Since I added that 5 rupees to the TC is added to the fair value of the asset, will I be able to unwind things at the rate of 10%, or would it trigger the need of calculating a new effective rate of interest? And I think you can easily vouch me for that. And that's rightly said, no, I cannot use this 10% because the rate which is used to calculate the fair value was 10%, but the unwinding cannot take place at 10%. So you need to recompute the EIR. So let's do one thing. Let's go for the calculations of the effective interest rate using a hit and trial. Now, let me make a statement and you can vouch me. Can I say, since you've added the TC to the initial recognition, I believe the outflow goes up. With the same inflows, the EIR will definitely go down. I repeat. Can I say, in this particular case, when you added the TC to the initial recognition, this means from the investor's point of view, the outflow has gone up. Instead of the outflow being 100, the outflow is 105. And with the same inflows, the EIR will definitely go down below 10%. So I think I can comfortably take a hit and trial and consider 8% rate of interest in order to make the calculations. So let's do one thing. Let's make the calculations of the NPV, let's say at the rate of 8%, and of course at the rate of 10% as well. So I'm going to calculate the net present value at the rate of 8 and 10% respectively. And when we calculate these things, we've already seen, we always look at the investor's perception. So we've got the present value of cash inflows, and we've got the present value of cash outflows, and we're going to get the NPV in this particular case. So if I calculate the inflows, we're going to get inflows of 10 rupees at the end of each year, and I need a factor at 8%. So if I take the factor at the rate of 8%, the third year end factor is supposed to be 0.794. And if I consider the cumulative factor, it's 2.577. And we're going to get this principal money of 100 rupees back at the end of third year. So you get an inflow of 10 rupees at the end of each year and an inflow of 100 at the end of the third year. And as far as the outflow is concerned, it's 105 because now I'm taking the transaction cost also into account. Similarly, I can do the discounting at 10% as well. So let's see the cumulative factor at the end of 3 years. So the third year factor in this case is 0.751. And the cumulative factor is 2.487. And the outflow is supposed to be 105, that is including the fair value. So I think we should get a positive NPV at 8% and a negative NPV at 10%. At 10%, we should definitely get a negative NPV to the extent of 5, though I think we can verify this as well. But we should definitely get a negative NPV to the extent of the TC. And yes, we are approximately getting 5.03, which is 5. And similarly, if I take the NPV at 8%, this is working out at a positive figure, I guess 0.17. We're quite close. So we've got an NPV which is positive at the rate of 8% and a negative at 10%. So we could interpolate and calculate the effective interest rate, or you can say the internal rate of return in this case. So this is going to be 8% plus, we take the NPV at 8% divided by the differences in the NPV, and the gap of the range is 2%. So we get the effective interest rate. So this is 0.17 divided by 5.17 into 2. I think this is coming to around 8.07% is my effective interest rate. Wow. So I have just made the calculations based on that if the TC gets adjusted to the value of the asset In this particular case, it changes my effective interest rate from 10% to 8.07%. Okay, now I'm not going to ask you a question at this stage. I'm going to ask a question a little later after I'm done with my leisure account for the FA. So let's do one thing. Now let's make a leisure account for the financial asset in this particular case. And I'm going to make this for a period of 3 years. So in the financial asset, I consider two banks, and this is to the extent of 105, including the TC, recorded at a fair value plus the transaction cost. You unwind the finance income at 8.07%. So 105 into 8.07%, that comes to approximately 8.47. You receive the contracted rate of interest, which is at the rate of 10%, that's 10. And we get a balance CD as a balancing figure. So in this case, your finance income is getting unwinded at the effective interest rate, and the money is being received at the contracted rate of interest. So 105 plus 8.47 minus 10, that works out at 103.47. Now let's take the balance BD in the next year, 0.47, and we again unwind the finance income at the rate of 8.07%, and that works out at 8.35. And again, we receive the contracted rate of interest, which is 10%, 10 rupee. We get a balance CD as a balancing figure. And again, let's make the ledger account for the third year as well. So 103.47 plus 8.35 minus 10, that's 101.82. So this becomes the balance BD in the next year. And again, we unwind the finance income, but let me not record this finance income. I'm going to take this as a balancing figure. So let me take this by bank. You're going to receive that 100 as well as the interest. So both the principal and the interest is received. We can comfortably take the balancing figure as 8.18. Wow, as a balancing figure to match up the ledger. Now, I think a very interesting question awaits you. Now, let me do something. Let me just add up the finance income for all the 3 years put together, and let's see what is the sum total of the finance income now. So 8.47 plus 8.35 plus 8.18, that works out at 25. Oh my God. Now, you know what, I am now going to ask you something. Can I see if you consider the finance income earlier without a TC was 30, and the finance income after the TC is 25. So is this difference attributed to the TC? Is this by chance, or is this got to be? My finance income in the previous case, when I ignored a TC, was 30 for 3 years, and now my finance income is supposed to be 25. The difference is due to the transaction cost 5. Is this by chance, or is this something which is got to be? So I think let's get your answers on that. So what do you say? The difference which I am getting in my leisure account, which is a difference of 5, is it due to the transaction cost of 5 which I've taken? Is this just a chance that we're getting 25, or is this something which is bound to tally every time? What do you say? And I think that's rightly said. Yes, it will undoubtedly match in this particular case. So this is something which I call it as got to be. So let me say a sentence, and I think you can vouch me for what I'm saying. So can I say, in terms of amortized cost accounting, what is technically happening to the TC? Is it getting spread over? Is it getting deferred over the life of the instrument in the form of reduced finance income? Can I say, if there would have been no TC, your finance income would have been 30? But now due to TC, the finance income is 25. So indirectly, your TC is getting spread over the life of the instrument by way of reduction in the finance income. Mind the words carefully. I'm putting it once again. So I'm saying that indirectly you can say that the finance income got reduced because of TC. When there was no transaction cost, my finance income was 30. With the transaction cost coming in, the finance income became 25. So that reduction of 5 is nothing but due to TC. So it is indirectly getting spread over the life of the instrument. I hope I am making good sense on what I am saying. Okay, so that's absolutely correct. So now what I can do further? I think I'm now just going to quickly give you some inputs, just vouch me. Then I think I can go to my second agenda regarding the processing fee. So first of all, I think let's consolidate the things. I'm concentrating on the financial asset, and I'll also simultaneously talk about a financial liability as well. Though we are focusing on the financial asset, but I want to focus on financial asset and liability both at the same time. Now we know that financial asset can be measured at AC, or the financial asset can be measured at FVTPL, or it can be measured at FVTOCI, that is NR, or it can be measured at FVTOCI, that is R. So I'm looking at the treatment of the transaction cost in nutshell with regard to the financial assets as well as the financial liability. So I'm going to make some few sentences. If you've got a trouble, you can stop me there and then. Now, as far as financial liabilities are concerned, there is no category called FVTOCI, because financial liabilities are either measured at AC or they are measured at FVTPL. So I put already a cross on the two categories. There is FVTOCI, R and NR. Now let's begin the journey with a financial asset. Can I say in terms of amortized cost accounting, what do you do? When you incur a TC, it gets added to the fair value at initial recognition. And the moment it is added, it immediately triggers the need of calculating a new effective interest rate. And we can also simultaneously say that by adding it to the fair value at initial recognition, what you're technically doing, it is getting deferred over a period of time. Look at the three inputs very carefully for a logical understanding. The TC is getting added to the value of the financial asset 1, and immediately it triggers the need to calculate a new effective interest rate. The rate which is being used to calculate a fair value cannot be used in the ledger account to unwind the discount. And number 3, it is getting spread over, it is getting deferred over a period of time, as I've already proved in the example. Similarly, if you look at the things from the point of view of a financial liability, it's a reverse treatment altogether. The TC is getting subtracted at the time of initial recognition. So we will subtract the TC from the fair value at the time of initial recognition, and this would also immediately trigger the need in terms of calculating the effective interest rate. The moment you make adjustments to the asset or liability, immediately what comes to the mind is that it would trigger the new EIR. Now, let me say something. Can I say in terms of financial asset, it is getting deferred in the form of reduced finance income? I said in terms of FA, it is getting deferred over the life of the instrument in the form of reduced finance income. Can I say in FL, it will also get deferred in the form of increased finance charge? Mind the words. In terms of financial liability, it will get deferred in the form of increased finance charge. Because when you go to calculate the EIR in terms of FA, the EIR in terms of FA will definitely go down. But the EIR in terms of FL will definitely go up. The moment you reduce the financial liability by the TC, your EIR will definitely go up. So your TC is getting spread in the form of increased finance charge in terms of financial liability. I hope I am making good sense. Visualize and just think of every word of what I'm saying. Okay, now let's come to the FVTPL. Can I say as far as a TC is concerned, it cannot be adjusted to the value of the asset. So The TC cannot be adjusted to the value of the asset. The TC cannot be adjusted to the value of the liability. All you need to do is that it's going to be immediately taken to the profit and loss account. There is no other treatment, but it is going to be immediately taken to the profit and loss account itself. This is when you are considering FVTPL. Now comes the concept of FVTOCI. Now, in terms of FVTOCI, what do? You will again add it to the initial recognition. And once it gets added to the initial recognition, what happens that at year end, when you go to consider, the changes in the fair value and you're going to take that in the OCI, you can say indirectly it gets transferred to OCI at year end. It'll get transferred to the OCI at the year end. Because when you add the amount of TC to the initial recognition and then you compare the fair value at the end of the year, so whatever is the difference between the initial recognition and the fair value at the end of the year gets transferred to the OCI. So can I say in this case, 100% of the amount is getting transferred to the OCI. 100% TC is getting charged in the other comprehensive income in the current year. So you can see AC leads to a deferment of TC. FVTPL leads to an immediate expense in the P&L in the same year itself, and even in OCI NR, it gets transferred to the OCI in the same year. There is no deferment in terms of FVTPL. There is no deferment in terms of FVTOCI NR. So in FVTPL, it is getting transferred to the P&L, and in terms of OCI NR, it is getting transferred to the OCI. I guess, friends, I am making good sense on what I am saying. Okay, now comes the last position, that if it is OCI recycling, same treatment, the TC is going to get added to the value of the financial asset in, and then at the year end, you're going to make a transfer to the OCI at year end, because you're going to compare the changes in the fair value at the end of the year, and you're going to put this amount in the OCI at the year. And once you were to put this amount in the OCI, the same thing will follow. 100% TC gets transferred to the OCI, but in this case, since it's a case of recycling, what do you need to do? You need to do an annual transfer. You need to do an annual transfer from the OCI to the profit and loss account of a portion of the TC every year. Now, how much portion is done, I'm not getting into all that, but there will be a need to transfer an annual amount from the OCI to the profit and loss each year. In case of no recycling, this is not required. But in terms of recycling, this annual transfer from the OCI to the profit and loss account will be required. Right, so this, I think, summarizes the position in terms of the transaction cost. So I can say, in terms of AC, it leads to a deferment. In terms of FVTPL, it gets immediately expensed. In terms of OCI NR, it gets expensed in the OCI in the same year. And in terms of OCI R, it gets expensed in the OCI, but you can say it leads to a deferment, because when you're going to transfer an annual amount from the OCI to the P&L, then you can say it indirectly leads to a deferment. Right, I guess I am now pretty clear on the concept of the TC, right? I guess I'm pretty clear on the concept of a transaction cost in all the permutation combinations. Okay, now I'm going to go to the next agenda with you. As I said, when I'm looking at the initial and subsequent measurements of financial assets, there were three issues which I pinpointed yesterday. One was the treatment of TC, and the second is in terms of processing fee. And then I'm going to discuss the difference between a transaction value and a fair value. So I think first of all, let's come to the concept of a processing fee with reference to both a financial asset and a financial liability. Now, let's consider the case of a processing fee. Now, as far as a processing fee is concerned, it is quite usual on the part of a bank that when you take a loan from the bank would generally ask you to pay a processing fee at time zero. The question again arises that is that processing fee a one-time income for the bank, or should it be spread over the life of the instrument? Well, logically, it's not a one-time income for the bank. In this particular case also, it should get spread over the life of the instrument. Just like the TC is getting spread over the life of the instrument, the processing fee should also get spread over the life of the instrument. Now, I want to look at the concept of a processing fee both from the angle of a financial asset and financial liability. Now, typically, you can see that when there is a case of a processing fee, I would say it would relate to a financial asset measured at AC. I would say it would relate to a financial liability measured at AC. So the concept of processing fee would technically be seen in a situation when you've taken a loan from the bank. The banks would be regarding it as a financial asset measured at AC. And for the other party, it becomes a financial liability measured at AC. So we're going to look at the concept of the processing fee typically from the point of view if the financial asset is measured at AC and the financial liability is also measured at AC. Now, think logically and decide what would be the treatment of this processing fee. You can always think in terms of the entry. When I gave a loan to someone, then I would have done the entry loan account debit and bank account credit. So when we gave a loan to someone, we created a financial asset, so financial asset to bank. Now, when the other person pays me a processing fee, the entry becomes bank account debit and processing fees gets a credit. And instead of the processing fee, you need to give a credit to the financial asset. So I think now you can logically decide what are you going to do with the processing fee. So the financial asset was given a debit when you gave the loan. The processing fee financial asset, which means what? That you reduce the processing fee from the financial asset value. So when the bankers would receive the processing fee, it would get reduced from the value of the financial asset. And what would this immediately trigger, friends? We've just seen that if you're going to make any adjustments to the value of the assets and liability, it will immediately trigger the need of calculating in EIR. Remember this as a golden rule, that the moment you're going to make any adjustments, we are going to immediately trigger the need of calculating EIR. So the processing fees will get reduced from the value of the asset, and it would immediately trigger the need to calculate the effective interest rate. Similarly, in terms of liability, when you took a bank loan, the entry became bank account debit and the financial liability is given a credit. Now, when you paid the processing fee, the entry became processing fees debit and bank will be given a credit. But instead of giving a debit to the processing fee, we're going to give a debit to the financial liability because we need to spread this over the life of the instrument. So in this case, when you took a liability, the financial liability got a credit. The processing fees made a debit. So we can say in this case, again, it's a reduction. So logically, again, a processing fees will get reduced from the value of the financial liability. And immediately, it would also trigger the need of calculating an EIR. Now, remember this, because sometimes people do tend to go wrong, that when there is a case of a processing fee, remember, it's a case of an income for one and it's a case of expense for the other. Now, in terms of TC, it is supposed to be an expense for both. Now, you would see a different treatment for the simple reason. When you look at the concept of a transaction cost, it's an expense for the issuer, it's an expense for the holder. But when you look at a processing fee, it is supposed to be, an income for the issuer, and it is supposed to be, you can say, the income for the holder as well as an expense the other way around for the issuer. So that means a processing fee gets a same treatment in the books of issuer and the holder. It gets reduced from the FA, it gets reduced from the financial liability, and immediately triggering the need of calculating an effective interest rate. So I've given you the logic also. Why is it getting reduced from the FA value? Why is it getting reduced from the financial liability value? Because the person who receives it will give a credit to FA. The person who pays it is going to give a debit to the financial liability. So both the ways it gets reduced, triggering the need of a new EIR calculations. Right. I think with this, I can now do a small little question also with you. And that's right, Shobhan. This is very much logical. Absolutely correct. Now, let's, I think, do one thing. Let's take a small little illustration with you based on the processing fee calculations. Let's go to the study material. And there is a particular question which is devoted to the concept of processing fee. So let me just take you to that illustration in the unit number 2. In the study material unit number 2, I'm going to take you to a question on this particular part. Just give me a second. Let me just locate that question. Right, let's have a look at illustration number 20. This is in the study material unit number 2, and this is on page number 12.47. So let me just mark this. We are on illustration number 20, and this is on unit number 2 of the study material, and that's on page number 12.47. So page number 12.47 of the study material. Let's have a look at this illustration. Now we're given in illustration 20, it says ABC Bank gave a loan to a customer, Target Limited. So we can say that ABC Bank, for them, it's a financial asset. And for Target, it is supposed to be technically a financial liability. And it carries a fixed interest rate of 10% for a period of 5 years and 12% for a period of 3 years. Additionally, the bank charges a processing fee 1% of the principal amount borrowed. Target Limited borrowed the loans as under 10 lakh for a period of 5 years and 8 lakh for a period of 3 years. Compute the fair value upon initial recognition in the books of Target, and how would the loan processing fees be accounted for? So let me, I think, outrightly say something. You can vouch me. Can I say ABC Bank would reduce it from the financial asset, and Target Limited would also reduce it from the financial liability? Both of them is going to reduce the amount of processing fee from the financial asset value and the financial liability value. And considering that now we need to calculate a new effective interest rate as well. So 10% is the rate of interest which is given for a 5-year loan, and 12% is the rate of interest given for a 3-year loan. As you make adjustments of the processing fee, immediately it would trigger the need of calculating a new effective interest rate as well. Am I thinking correct? So if you think from point of view of the bankers' reduction in the FA, if you think from the point of view of Target Limited, again, a reduction from the FL, triggering a need to calculate the new effective interest rate in this case. Right, I guess, friends, you agree with this, I believe. And that's rightly said. So let's now do one thing. I think I'm not solving the two loans. I think I'll just pick up one of the loans. So let me, I think, consider one loan, because there is a 10 lakh loan for a period of 5 years and there is an 8 lakh loan for 3 years. So I can just pick up one of them. And I think you can do the other one on the same lines. So let me take that 3 lakh rupee 3 years loan to make it simple. Let's consider this from the point of view of the bankers also, and let's consider this from the point of view of Target Limited also. So let me do the workings on this. So let's first of all do the things from the point of view of the bank. Now, if I go from the bank's point of view, can I say in this case, if you look at the value of the financial asset, if I consider the transaction value and the fair value to be the same, we can say 8 lakhs becomes a transaction value or a fair value. And there is a processing fee, and the processing fee is at the rate of 1%. So we make a 1% reduction. So we get the value of the financial asset, 8 lakhs minus that 1%, that works out at 7,92,000. That is the value of the asset. Now, let me ask you something logically. Once you made a reduction of this from the financial asset value, what do you think the EIR will go? Is it going to go up or is it going to go down? The rate of interest which is given on a 3-year loan is 12%. So when you're going to calculate the new EIR, do you think it's going to go up by 12% or it's going to go below 12%? A reduction in the value of the asset would mean a lower outflow. And if the inflows remain the same, it would definitely increase the effective rate of interest. So we're going to get an answer which is going to be 12% plus in any case. So we're going to get more finance income. So indirectly, your processing fees is going to get spread over the life of the instrument in the form of, you can say, increased finance income. I repeat, that once you're going to get the new EIR, your processing fees is getting spread over the life of the instrument in the form of increased finance income in this case. So I think let's use a hit and trial technique to calculate the things. So let's take the NPV at 12% and let's take it at 15% to get more accurate results. So we consider the present value of cash inflows and we consider the present value of cash outflows, and we're going to get the NPV. So let's consider the inflows for a period of 3 years. So on 8 lakh rupees, the contracted rate is 12%. That works out at 96,000. And then you're going to get this 8 lakh rupees back at the end of third year. So let's see what is the factor at 12%. So at 12%, my third year factor is 0.712. And the cumulative factor is 2.402. And as far as the outflow is concerned, the outflow is going to be 7,92,000. And I think at 12%, we should get a positive NPV, which should be exactly 8,000. We can make a check as well. So this is 569,600. So yes, we are getting approximately a positive NPV at 8,000. So naturally, at 12% rate of interest, the difference has to be attributed to the processing fee. Now let's consider at 15% what is the discounting factor. So at 15% at the end of third year, that works out at 0.658 at the end of third year. And we get a cumulative total 2.283. And the outflow is supposed to be 7,92,000. So we should get a negative NPV at this stage. So 0.658 into 8 lakhs, 526,400. So I think this is coming to a negative NPV of 46032 negative. I think the workings are correct. Let me just check this once again. 658 into 8 lakhs is 526,400. 526,400. So we are getting a negative NPV 46,432, I guess. So 46,432 is supposed to be the negative NPV, I guess. Okay, so now we can interpolate this and get the effective interest rate as well. So we can get the effective interest rate. This is going to be 12% plus the NPV at 12% divided by the difference in the NPVs. So this will become 46,432. And the gap of the range is 3%. We interpolate this and we get the effective interest rate. So 46,432 plus 8, 54432. So I think this is coming to around 13.18%. So this will come to 13.18%. Now, let me ask you a small little question which you can vouch me. Can I say if I were to ignore the processing fee, hear this very carefully. If I were to ignore the processing fee, the sum total of the finance income on one hand, and if I consider the processing fee and I get the sum total of the finance income, Do you think the difference in the two finance incomes is going to be 8,000? I put this again. If you ignore the processing fee and get the finance incomes, and on the other hand, you consider the processing fees and get the finance income, is the difference in the two finance income going to be equal to 8,000, which is the processing fee? What do you say? If you can answer this, then I think you've got the logics very clear. You get the finance income ignoring processing fee. You get the finance income considering a processing fee. The difference between the two, can I say, is going to be equal to 8,000. That is the processing fee. That's rightly agreed. Absolutely correct. Wow. Okay, so I think we've understood the logic. And I think with this, you can easily prepare the ledger accounts as well. So the treatment of the processing fee is also taken care. Now we move on to the next agenda. So I think I've given you the treatment of TC in terms of FAFL. I've given you the treatment of processing fee in terms of FAFL. Now we're going to go to the third and the very important agenda, which is very important from the examination point of view. And that is when there is a difference between a transaction value and there is a difference in terms of fair value, what do we do with this particular difference? So I think now I'm going to first take you to a chart which is given in the study material, and I'm going to illustrate this concept to you that when there is a difference in the transaction value and the fair value, what do you do? But before that, let me now first give you a chain of thought. Let's say if I'm looking at a financial asset and let's say I'm looking at a financial liability. Now, very carefully, let's have one thing very clear. In terms of financial asset, the entry is financial asset debit and bank is given a credit. Now remember, the financial asset is initially always recorded at a fair value. The bank figure is going to be recorded at a transaction value. So if, let's say, for example, you invested 10 lakh rupee, if, for example, if you invested 10 lakh rupee, then we can say that is the transaction value. But then when you record a fair value, what is a fair value? It is supposed to be the present value. It is supposed to be the present value of all the future cash inflows. So let me now ask you something and analyze this very carefully. Can I say when you calculate the present value of cash inflow, if the contracted rate is, let's say, 10%, and the rate at which you calculate the present value is also 10%, the transaction is done at a market rate. So that means the contracted rate and the market rate is same. So when you calculate the present value of the inflows, which is you receive 10%, you discount at 10%, do you think the fair value and the transaction value will match? I put this again. If you say that the contracted rate and the market rate is same, the transaction took place at market terms itself. So when you calculate the present value of the inflow, you said you're going to receive a interest and you're going to discount it at the same rate of 10%. We did the discussion earlier as well. The rate at which the interest is computed is 10%. The rate at which it is discounted is also 10%. Do you think the transaction value and the fair values will match in that case? Yes, absolutely. So in this particular case, the transaction value and the fair values will be same. But if the contracted rate and the market rate of interest is not the same, then there will be a difference between the fair value and the transaction value. So in this particular case, there will be a difference arising in this particular entry. So the agenda is, how do you account for the difference in that entry? I put this once again. When you record a financial asset in the books of accounts, remember the financial asset is recorded at a fair value and the bank is given a credit at a transaction value. Now, there are two circumstances. If the contracted rate and the market rate is same, in those particular cases, the fair value and transaction value will match. Because you said, I'm going to get the future money at 10%. And when you discount it at the same rate of 10%, the compounding and the discounting is taking place at the same rate of interest. So in those particular cases, we can say the transaction value and the fair values will match. It is only in those questions where the contracted rate and the market rates are different. In those cases, the transaction value and the fair values are going to be different. Same is the case in terms of financial liabilities as well. In terms of financial liabilities, the entry is bank account debit. This will be the transaction value. If you borrowed 10 lakh rupees, you put in the bank, debit what comes in, so transaction value is given a debit. But in terms of the financial liability corresponding credit, it is always taken at a fair value. Here again, if you see in the question that the contracted rate and the market rate is same. Now, when I say fair value, the fair value basically means that you're going to consider the present value of all the future cash outflows. In terms of the fair value of the liability, you will consider the present value of all the future outflow. So if the contracted and the market rate is same, you are to pay at the rate of 10% and you're going to discount it at the rate of 10%. So if the contracted and market rate is same, the transaction value and the fair value will be same. But if the contracted and the market rate is not the same, then again, I'm going to get a difference in this particular entry. So the very first thing which you need to watch out in any question is compare that if in the question he gives you a contracted rate information and he gives you a market rate information and the two are different, you will definitely get a difference in the entry. Whether it's a case of a financial asset or whether it's a case of a financial liability, you will get a difference in the entry for sure. So I think let me do one thing. Let me show you a few sample questions where the question is going to clearly give you the information that there is a difference between a contracted rate and a difference between a market rate, which will indicate that what we technically say it's an off-market transaction. So if it is an off-market transaction, there will be definitely a difference in this entry. Let's, I think, have a look. So let me just take you to a few examples which are given in the study material itself in unit number 2. So I think let's have a look at one or two questions which are given where the transaction value and the fair values are going to be different. I think let's have a look at, first of all, illustration number 25. Now, if you look at the illustration number 25, I am given that A made a security deposit. So company A made a security deposit. So that will become a financial asset for the company. And then it says, assume the market interest rate for the deposit is 12%. But if you look at the rate of interest which is contracted on the deposit, it is 0%. So but that's not given in the question. Well, in the absence, I'm presuming that there is no interest which you are receiving on the deposit. The company made a deposit with their suppliers, and the supplier says, we're not going to pay you any interest. So the contracted rate of interest is 0 and the market rate of interest is 12%. So the transaction is made at off-market terms. And the moment the transaction is made at off-market terms, there is bound to be a difference in the journal entry, because the financial asset will be taken at a fair value. The bank will be given a credit at a fair transaction value, resulting in a difference. How do we treat the difference? We'll learn that, no issue. So this was one example. I think I'll show you another example as well. I am taking you to one of the comprehensive illustration, the last unit of the study material. There is a last unit in the study material which talks about comprehensive illustrations. And if you look at the very first illustration given in the question, it says A issued redeemable preference shares to its parent company, that is Z. So the subsidiary company has issued preference shares to the holding company, and the terms of the instrument is given. Now you can see very clearly towards the end, the dividend rate on this instrument is 0.0001%. So the contracted rate of dividend in this case is practically 0. And if you look at the market rate of interest, it is 12%. The question will be very clear on the agenda that when you look at a particular question, you'll see that the contracted rate is different and the market rate is different. The contracted rate is negligible, practically 0%, and the market rate is 12%. It's an off-market transaction, resulting in that there will be definitely a difference in the asset and the liability figures. The financial asset would be recorded at a fair value. The bank figure will be recorded at a transaction value, resulting in a difference. Okay, I hope I have made myself clear on this particular case. Now, let me take it further. And Shubham, you said a hidden portion would be an equity component. No. Now, let me tell you, it's not a case of a compound financial instruments where we're going to say the difference is equity. No. Now, what I'm going to do, I am going to give you again a three-step model based on which we'll be able to crack down a lot of questions. So wait and watch for this three-step model, that when there is going to be a transaction at off-market terms, I'm going to give you a three-step model which we're going to follow. And I made a trail of questions where I'm going to cover up each and every permutation of combinations with you. So another 10 to 15 minutes and you get a clarity, and then we're going to do some practice questions with you on this area. So let me begin the journey. I'm first of all coming to a chart in the unit number 2 of the study material. There is a wonderful chart which connects me in terms of, you can say, the difference in transaction value and a fair value. Now, please hear me very carefully. This is slightly technical, but I'll give you a three-step model based on this chart, and we'll be able to crack down the question. So 10 to 15 minutes, you get the entire concept, terms and conditions apply. Let's begin the journey. Well, step number 1 in every question is going to be, you need to compare that the transaction is at market terms or the transaction is at off market term. The question rises, what do you mean by at market terms and what do you mean by off market terms? If your contracted rate and the market rate is same, if your CR and MR, I'm calling it CR as a contracted rate and MR as a market rate. If your contracted rate and the market rate is same, we say it is at market terms. Then 100% guarantee your transaction value, or you can say transaction price, whatever, your transaction value and your fair value 100% is going to be same. So if in a question you find that the contracted and the market rate is same, there will be no difference between a transaction value and a fair value. My job is done. Now, if you see in the question that the CR, that is the contracted rate, is different as compared to market rate. And let me tell you, you will only see a situation where the CR is less than the MR. It is not logically possible that the contracted rate is more than the market rate. So you would either see a situation CR and MR is common, in which case transaction value and fair value is same, or you would see a situation when the contracted rate is lesser as compared to the market rate. This is called off-market transaction. So your step number 1 is to make a comparison of CR and MR. If you notice so far, the questions we've done in financial instruments, we've not seen any questions where the information on the CR and the MR is given. So at the first instance, when you read a question, look at the CR and MR. I think what I'm going to do, I'm just going to share a certain questions with you where I have tried to organize a few questions in a chronological order. You know, some questions are there in the examination, some questions are there in the RTPs, and some questions in the study material, so that you get a little chain of thought. We'll work upon these questions, but let's have a look at the question number 13 in front of you. Now, when I read the question number 13, it says N granted a loan to O at the rate of 10%. So there has been a loan which N gave to O at the rate of 10%. So what is the 10%? It's a contracted rate of interest. But he says, but the incremental borrowing rate is 12%. So what is this? This is the market rate of interest. So you can say the contracted rate is 10% and the market rate is 12%. So we can see clearly that this is an off-market transaction. I'm not reading further. I'm not reading further. This was a November 18 examination question. Quite recently in November 2020 examination, we got a similar question like this. It says on 1st April 2020, Star advanced a housing loan of 15 lakhs to one of its employees at an interest rate of 6%. So what is the contracted rate of interest? It is 6%. Then he says the market rate for a similar loan by banks is 10%. So what is that similar loan? It is a market rate of interest. The contracted rate is 6%. The market rate is 10%, very clearly indicating it's an off-market transaction. Similarly, if you look at the illustration which we saw on the deposit, this question came in November 19 examination. In this case, we're given the market rate of interest is 12% and the contracted rate is 0. So since the contracted rate is 0 and the market is 12%, indicates it's again an off-market transaction. So you can clearly see in these questions that we can see that there is a difference between the contracted and the market rate. Then I showed you an illustration in the comprehensive illustrations in the study mat, and the illustration 1 came in May 18 examination. Now, in this particular case, the contracted rate is 0.0001% and the market rate is 12%. So all these questions are very clearly telling you that there is a difference between a contracted rate and a market rate, indicating it's an off-market transaction. So the very first step in the question is to compare the CR and the MR. If the CR is equal to MR, then the transaction value, fair value is same. But if the contracted rate is less than the market rate, it indicates it's an off-market transaction. So I think let me just document my steps side by side. So what I'm working on, a 3-step model goes like this. So at the first instance, what you need to do in step number 1, you need to compare the contracted rate versus the market rate. So there are 2 possibilities. Either the contracted rate is equal to the market rate. If yes, it is at market terms. And in this particular case, your transaction value and fair value will be equal. So no differences will arise in the entry. But if you notice that the contracted rate is less than the market rate, in this case, we can say it's an off-market transaction. And if it is an off-market transactions, go to the step number 2. No hurry, go to the step number 2. I guess my step number 1 is pretty clear. So the first step is only making a comparison in terms of the contracted and the market rate to decide, is it at market or off market transaction? Then we go on to the step number 2. Now, in terms of the step number 2, one thing is pretty clear, that the transaction value and the fair value is not the same. So there is a need to compute the fair value. So there is a need to compute the fair value in this case. Now, let me tell you, when you go to calculate the fair value, in this particular case, we will need the help of Ind AS 113. When you go to calculate the fair value, in this case, we'll need the need of Ind AS 113. Now, very carefully, let me just come back to the chart in the study material. Now, see what it says. When it says instrument is at off-market terms, determine the fair value of the financial instrument. I guess, friends, you've done Ind AS 113. You've got some basic good knowledge on the standard, right? So I can presume that you've got some basic understanding on this, right? I can take it further. So let me still give you some inputs. When you calculate a fair value based on Ind AS 113, you know that the fair value considers the input, the data, which is either observable or it is unobservable in nature. I put it again, I'm not talking in terms of Ind AS 113. So when you calculate the fair value calculation is done on the basis of Ind AS 113. And Ind AS 113 says that there are 2 kinds of data with the help of which you calculate a fair value. One is called observable data and one is called unobservable data. Now, when you say it is observable data, it is more reliable in nature. And when you say it is unobservable data, it is unreliable in nature. The standard Ind AS 113 lays a greater emphasis on the part that when you calculate a fair value of the asset or liability, you need to consider observable data into account. We put more reliance on the observable inputs rather than the unobservable inputs. Then further, the standard tells us that when you consider any kind of data, whether it is observable or unobservable in nature, it is categorized in terms of level 1 inputs, level 2 inputs, and in terms of what you call level 3 inputs. We can say that level 1 input is supposed to be a directly observable data. So when you look at an observable data, a directly observable data is supposed to be a level 1 input. And you can say that if there are certain adjustments made to the observable data, then it becomes a level 2 input. So you can say an observable data without any adjustments is called a level 1 input, and an observable data with some adjustments made, it becomes a level 2 input. So we can say the observable data would be in two kinds of things. One is a level 1 input, which is supposed to be directly observable without any amendments and changes, you pick it. Then there is an observable data where you make certain changes and then pick it. And then there is unobservable data. So can you take an example and illustrate the concept of this observable and unobservable and the level 1, 2, 3? I'll do that. Let's consider that I made an investment in equity shares of a company. So let's say, for example, I invested into the equity shares of a company, and these shares are listed on the stock exchange. The company in which I made my equity investment is listed on a stock exchange. So if I want to get the fair value of those equity shares, is there an observable data? Yes, there is an observable data. And it's something which is directly observable in nature. And if it is directly observable in nature, then I am going to say that it's a level 1 input. Next, let's say, for example, I invested in an equity share of the company. The shares of that company is not listed, but a similar company shares are listed. So we are saying that I invested in a company share whose shares are not listed, but a similar company shares are listed. So what I could do, I could pick up that observable data and make some amendments, make some adjustments, and get the fair value of the concerned equity share. So you're taking the fair value of a similar equity investment and you're making some changes to that particular value. This is again observable data, but you're going to make some changes and then take the data. It's called a level 2 input. But let's say, for example, a third case, you invested in the equity instruments of a company and the share is not listed. A similar company share is also not listed. Neither that company shares are listed, nor a similar company shares are listed. Then what do we do in that particular case? I would take cash flow estimates from the management. I would consider that let's calculate the fair valuation based on the projected inflows and the projected cash flow data is made. This projected data is supposed to be an unobservable data. So when you're going to consider this unobservable data, it becomes the level 3 input. So whatever data goes in the calculation of the fair valuation as per Ind AS 113 is either observable, classified as level 1 if it is directly observable, or classified as level 2 if it is picked up with certain amendments, and unobservable data will be called as a level 3 inputs. I guess, friends, I'm clear with the concept of observable and unobservable as well. Okay, that's wonderful indeed. I think I got some good inputs on this. Wonderful. So you need to calculate and see that the fair value calculation is based on what kind of inputs. Now see in the chart what it says. If the fair value is based on a level 1 input or a valuation technique that uses only data from observable market. So I would say that if you're picking up your fair value calculations based on a level input or a level 2 inputs, that is one case. And if it is any other basis, that means you picked your fair valuations based on unobservable inputs. Then it becomes any other basis. Now, what does the standard say? That if your fair valuation is based on a level 1 input or a valuation technique which uses only observable data, observable markets, Any difference in the transaction value and the fair value is going to be called as a day one gain or loss. It's going to be taken immediately in the profit and loss account. It's called the concept of a day one gain or a day one loss as per Ind AS 113. And if it is any other basis, then the difference between the transaction value and the fair value is going to be taken as an asset if it qualifies to be, or it's going to be amortized in the profit and loss account as the case might be. So could you elaborate that? I think let me just come back to my three-step model and illustrate it further. So if I come back to my step number 2, what do I need to do? You calculate the fair value based on Ind AS 113. Now, once you calculate the fair value based on Ind AS 113, now what do you need to do in this particular case? You need to see that the valuation considers the observable data or is considering the unobservable data. If it is considering an observable data, then the treatment is simple. The difference in the transaction value versus the fair value is going to be called as a day one gain, or it's going to be called as a day one loss. And that day one gain or loss is going to be simply taken in the profit and loss account. It's a gain or it's a loss as the case might be, and you're going to put that gain or loss immediately in the P&L. It's called a gain or loss arising on day one. This is what we technically call a day one gain loss. But if it is unobservable data, I would say go to the step number 3. So will we be given information in the question which will tell us that this is a fair valuation based on observable or unobservable data? Yes. So you will be given the information directly, indirectly, which will tell you that this is based on observable or unobservable data. Now, let me take it further. Now, when I go to the step number 3, watch out this step number 3, Taylor made the step from the examination point of view. In step number 3, I am going to look at the type of relationship. Sir, type of relationship? Yes. In step number 3, I'm going to look at the type of relationship, that the transaction is happening between which parties. Now you can see that typically if you look at the questions, you will find 3 kinds of relationships. You're going to find 3 kinds of relationships in the question. The relationship 1 is, you can say, employer-employee. Is going to be called as an employer-employee relationship. It is sometimes you will see a very common feature. The employer gives a staff loan to the employee. He gives him a concessional staff loan. The concession has been given because of the consideration of the relationship between the two. So it is very common that the employer gives a loan to the employee, which is a concessional staff loan. So we need to see if that is the kind of relationship. The second kind of relationship you're going to see is a supplier and a customer relationship. Is going to be a supplier and a customer relationship. There is quite a possibility, like for example, the customer gives a security deposit to the supplier, and the supplier does not pay him any interest on that security deposit, or pays him a very nominal interest on that security deposit. So we need to see that the deposit is there. So there is a supplier-customer relationship. And the third most common one, you can see that there is a holding subsidiary relationship between the two. You can see that many a times a parent company would give a loan or would invest in an instrument in the subsidiary, which is going to be below market rate of interest. So it's a common tendency. So you will see that there are 3 kinds of common relationship. I'm not saying that this is an exhaustive list of relationship, but if you look at the kind of questions which are asked in the exams and given in the study material, you will see that there are basically 3 kinds of relationships you will see. When you see that there is an employer-employee relationship, or you see that there is a supplier-customer relationship, or you see that there is a parent-subsidiary relationship. Now let's have a look at each of these relationships to begin with. If there is an employer-employee relationship, let's look at the books of the employer. He gives a staff loan, which creates a financial asset in the books of accounts. That's right. The staff loan creates a financial asset at a fair value. and he gives a credit to the bank figure, which is supposed to be recorded at a transaction value. Since it is a concession loan, naturally the fair value is going to be less as compared to the transaction value. So there will be a difference arising in this entry for sure. So let me ask you something. Can I say this can be indirectly treated as a prepaid staff cost? Because if the employer is giving a concession loan to the employee, then in this particular case, he is indirectly saying, okay, you give me services during the period of the loan, and I'm going to give you a concession in terms of the rate of interest. So indirectly, we can say this concession is nothing, but we can say indirectly a prepaid staff cost. So whatever difference arises in this entry is going to be taken as a prepaid staff cost. Does it create an asset, or does it create an expense which is to be amortized over the life of the loan? It creates an expense, you can say a deferred expense, and this is going to be amortized over the period of the loan. This is going to be amortized over the life of the loan. So this is how we're going to treat the difference in a transaction value and a fair value. If there is a loan, a concession loan between the employer and employee, the difference in the entry is going to be attributed to a prepaid staff cost. And this prepaid staff cost is going to be written off over the period of the loan. And this will be done on a straight line method. So whatever is the difference which attributes in this entry is going to be spread over the life of the loan on a straight line basis. And I think it makes common sense. Similarly, if you look at the other one, there is a relationship. So let's say, for example, the supplier has given an asset to the customer on a lease. And we know that this is now all a case of finance lease. Ind AS 116 recognizes that when you take an asset on a lease, it's going to be undoubtedly a case of finance lease for a customer. So let's consider the customer has taken certain assets on a lease, and he's also made a security deposit to the supplier, which is at off-market term. So if you look at the books of the customer, he would say that let me record the security deposit, which is supposed to be a financial asset in the books of accounts. And this will be recorded at a fair value. And when he made a deposit, the bank is given a credit to the extent of transaction value. Now, since the deposit is made at off-market terms, so naturally the fair value of this deposit is going to be less than the transaction value for sure. So there will definitely be a difference which will arise in this particular entry. So the question arises, how do we tackle the difference? Now, when the customer took the asset on a lease, he would have done the entry ROU asset to lease liability by virtue of Ind AS 116. I repeat, because many of you might not have done Ind AS 116 so far. So when the customer would have taken the asset on a lease, he would have done an entry ROU asset to lease liability in the books of accounts apart from this deposit. So what we're going to do in this entry, if he makes a deposit which is below compared to the market terms, the difference in this entry is going to be treated as an ROU asset. Indirectly, we are saying that this is like a lease payment which is made by the customer to the supplier. So the difference in this entry is going to be called as a right of use asset. And how do you tackle that ROU asset? This ROU asset is going to be depreciated over the lease term by the implications of Ind AS 116. So this ROU asset is going to be depreciated over a period of time. And this is going to create indirectly, you can say, an asset in the books of the customer. So you can see a supplier-employer-employee relationship triggered a creation of a deferred expenditure, which is to be amortized over the period of the loan. A supplier-customer relationship created an asset because it is eligible that we can create an asset in the books of accounts, and this asset gets recognized in the form of a right of use asset, which will be depreciated over the period of the lease term. Now, let's have a look at another combination as well. The third kind of common transaction which you're going to see is the case of a parent and subsidiary. The parent company invested in the instruments of the subsidiary, which is at off-market terms. So he would pass an entry when he made an investment. Let's say, for example, he gave a loan. So he would create a financial asset in the books of accounts, and this will be recorded at a fair value, and he will give a credit to the bank, which is being recorded at a transaction value. Since it is again an off-market transaction, there is bound to be a difference arising in this entry as well. The financial asset will be recorded at a fair value, and the bank will be given a credit at a transaction value. So what is the difference? It is supposed to be a deemed equity investment, because the money which he is investing against this particular instrument, some portion is being invested against which he gets no right to receive. So this difference is going to be taken as a deemed equity investments in the books of the parent company. So you're looking at all these transactions from the point of view of the financial asset. So do we need to look at these transactions from the point of view of the other party as well? Yes. But then I think from the employee point of view, we are not considering entries because employees will not do accounting. And I think even from the customer point of view, I think unless the customer applies Ind AS, we are not looking at that. But yes, the examiner would be interested in asking you the accounting in the books of parent company and the accounting in the books of subsidiary company. Now, the entries in the third case in the books of subsidiary, he would put the entry bank will be given a debit at transaction value, financial liability will be given a credit at a fair value, and the difference will be taken as a deemed capital contribution. So we'll see later once we come to the practical illustrations, but I've just given you a sample of the inputs. I think let me make a walkthrough on my step number 3 once again. Rather, let me just consolidate my 3-step model in terms of transaction value and a fair value. So the first thing what you need to do in every question is watch out that if you are given information on the contracted rate and the market rate, I said CR and MR. If you notice that the information is given and the CR MR is same, even if the question is silent, we're going to assume that the CR and MR is same. So let's say when you pick up questions and you don't see any information regarding the market rate of interest, it's always convenient to assume that the contracted and the market rate is same. So if they are same, then there is no difference in the transaction value as well as the fair value. But if the contracted rate is less than the market rate, it creates an off-market transaction. You need to go to the step number 2. In step number 2, you need to calculate a fair value, and it all depends upon what is the source of calculating a fair value by virtue of Ind AS 113. If the fair value data is based on observable inputs, then any difference in the entry will be called as a day 1 gain loss, and it will be taken in the profit and loss immediately on day 1. But if you say that you've calculated the fair value based on unobservable data, then you need to go to the step number 3. In step number 3, watch out for the type of relationship. Generally, you will see 3 kinds of relationships present. Either it's an employer-employee. In such a case, we create a difference as a prepaid staff cost to be amortized over the period of the loan. The second is a supplier and a customer relationship, wherein I will consider that you've taken an asset on a lease and you've already created a right of use asset in the books of accounts. So even in terms of this deposit, which you've given to the supplier, you need to consider the difference as a right of use asset, which is going to be depreciated over the period of the lease term. And if it is a case of a parent-subsidiary relationship, then it will be considered as a deemed equity investments in the books of parent, and it's a deemed capital contribution in the books of the subsidiary. I guess, friends, I am making good sense on that. Okay, so I think we're getting a few questions. Manini, you said, so only 3 types are there. Well, as I said, this is not supposed to be an exhaustive list of permutation combination. Based on the kind of questions which I've seen in the exams and in the study material, you can see that this is more or less a list which helps you from the examination point of view. But of course, in a practical life point of view, there could be a numerous number of situations as well. And we'll have to take the guidance in terms of either the respective Ind AS or based on the guidance given in 13 or Ind AS 109, and accordingly decide where do we consider the difference. Let's now look at the chart back in the study material. And now I think you can easily understand every component of this chart. So when it comes to the initial measurement, we said that if the instrument is at market terms, the transaction value and the fair value is same. The value is based on level 1 inputs or any technique which uses observable data. The difference is taken to the P&L called a day 1 gain loss. Otherwise, we go to the step number 3. The difference between the fair value and the transaction price is recognized as asset if it qualifies to be. So if you look at my step number 3, asset, if it qualifies to be, is a case of ROU asset, correct? And otherwise, it is amortized to profit and loss account. Am I amortizing that amount of prepaid staff cost to the P&L over a period of loan? Yes. So either it becomes an asset if it qualifies to be, or it is otherwise taken to the profit and loss account over the period of the life of that transaction. Wow. I think now what I need to do, I should now take you to the trail of questions, and we should, I think, make a walkthrough in terms of this 3-step model and decide that which case do we do. I have taken a trail of 4 questions with you. One questions you're going to see, it's a case of day 1 gain loss. Another question you're going to see, employer-employee relationship. Another question you're going to see is a customer-supplier relationship. And another question you're going to see is a case of holding subsidy. But before that, let me also caution another thing to you. This concept of the 3-step model is not applicable. It's not applicable to a situation where you say it's a case of a loan which is recoverable and payable on demand. If you see, because Ind AS 113 makes it very clear that in case a loan is payable, a loan is recoverable on demand, we always consider the transaction value and the fair value is common. So if you see in a question that there is a case of a loan recoverable or a loan payable on demand, that means it is immediately receivable payable. The transaction value and fair value is considered to be common, then this 3-step model is not applicable. So in this case, this is the only exception you need to take care. So I would say you need to practice a total of 5 trail of questions with you. Number 1, you need to concentrate on a case where there is a day 1 gain loss. Number 2, employer-employee. Number 3, customer-supplier. Number 4, parent subsidiary, and the loan recoverable payable on demand. Once you're able to crack these 5 questions, life becomes jingalala. So I think you must be very eager to have a look at these questions now. And you want to see the trail of how do we identify this 5-step model. Let's start zigzag. Let's start zigzag with you. And I think let's have a look at the question number 20th with you. This is again a very popular kind of question number 20th, which you can see came in RTP and then came in October 20. It also similar kind of question came in December 21 as well. So why not have a look at the December 21 examination question? Let's have a look at this and get your inputs on this. RAM Limited is a company incorporated in India. It provides a 25 lakh interest-free loan. The moment I read interest-free loan, you know what comes to my mind? That this is an off-market transaction, because you are giving an interest-free loan to the wholly owned subsidiary company and there is no TC. Then he says, how should the loan be accounted for in the light of the provisions related to Ind AS in the books of RAM, in the books of Balram, and in the books of consolidation? Now, I am not solving this question right now. I'm just making a little walkthrough in terms of how the things will be done. Now, it says there are 3 scenarios which are given. The loan is repayable on demand. If the loan is repayable on demand, is this chart going to be applicable in this particular case? No. Then he says in the second case, so I would say in the first case, you would record the financial asset and the financial liability in both the set of books, can I say at a transaction value itself. Ram would put the entry recording the financial asset at 25 lakhs, which is the transaction value. And the subsidy Balram would also record the financial liability at the fair value or the transaction value, whatever you call it. The second is that the loan is repayable after 3 years. Now, if it is repayable after 3 years, then it is certainly a case where it's not repayable on demand. The current market rate of interest is 12%. Oh, I think it's very clear that the contracted rate is zero. The market rate is 12%. So it's an off-market transaction. And I think the question is very, very clear on the agenda. You see the relationship of the parent and subsidiary. So can I say in this case, from the point of view of the parent company, it becomes a deemed equity investment. And from the point of view of the subsidiary, it becomes a deemed capital contribution. Am I thinking correct? That if you look at from the point of view of the parent company, it's a deemed equity investment. And from the point of view of the subsidiary, it becomes a case of deemed capital contribution. And then the third case, the loan is repayable when Balram has funds to repay the loan. Now, if it is a conditional loan that it's going to be repaid when the money is available, again, it's not a case of a loan. If it is not a case of loan repayable on demand, then the same answers would follow what we did in the point number 2. I guess I'm pretty clear on that. And that's right. I think Koshki, you said it very correct that this is, an exception. Another exception is also the case where it's a case of trade payables and trade receivable. Absolutely. So we can say there will be 2 exceptions when the concept of this off-market transactions concept will not apply, when it's a case of trade receivable, trade payable, and it's a case of loan recoverable payable on demand. Okay, so this was one kind of question. Let's have a look at another one. I guess if I look at the question number 18 now, in this particular case, or rather we can have a look at the question number 18, which is an examination question again. It says M made a security deposit and he's taken the asset on a lease and he's given a deposit for a period of 5 years and I am not given any rate of interest. The contracted rate of interest is 0. And in the end, it says, assume that the market rate is 9%. I think it is pretty clear. The contracted rate is 0. The market rate is 9%, makes it an off-market transaction. And the moment it becomes an off-market transaction, I am clearly seeing that there is a relationship as well. So you are bypassing the requirement of looking at the fair value calculation. Well, I think in the questions where the relationship is very, very apparent, I don't think so. I need to actually, look at the step number 2 keenly. So the relationship is of a supplier and a customer. So I think in this case, the difference is going to be a right of use asset in the books of accounts. Wow. I think then let's have a look at the question number 14 as well. Now, in terms of the question number 14, we given that the company Star Limited gave an advance, a housing loan to employee at 6% rate of interest, whereas the market rate is 10%. I think it's very clear now that it's the contracted rate is 6%, market rate is 10%. So there is definitely a difference. Employer-employee relationship, I would take a prepaid staff cost in that case. So now let's, I think, have a look at another one. Let's look at illustration, the question number 13. This is a November 18 examination question. Now let me ask you something. It says N granted a loan of 120 lakhs at the rate of 10%, which is a treasury bond YTM. Yield to maturity is what we call a YTM. So the loan is granted, which is based on a YTM. Now you would notice something, friends. In all the previous illustrations, in all the previous questions which I made a walkthrough, was there any observable data based on which the rate of interest, the contracted rate, was determined? Did the employer-employee relationship, the employer decided a rate of interest based on an observable market? No. In case of the parent-subsidiary relationship, did you see that he fixed up the rate of interest or a dividend rate based on a market information? No. In this case, we can see that the loan has been granted and the rate has been fixed based on observable data. Did you get my point? That N granted a loan to the company O, which is at 10%, and it is based on a YTM of a treasury bond. So there is an observable data on the basis of which the interest rate has been fixed. But the incremental borrowing rate of the company O is at the rate of 12%. So in this particular case, since it is based on, you can say, observable data, now if you're going to get a difference in the transaction value and the fair value, this is going to be called as a day one gain or loss. This is the only beautiful question which came in November 18 examination questions, where the difference in the transaction value and the fair value is attributed to the concept of a day one gain or loss. And as it is, you can see that there is no relationship between N and O as well. Unlike other questions where there was an employer-employee or a customer-supplier or a parent-subsidy relationship, in this case, there is no such relationship. It's a plain vanilla case where two parties are transacting with each other. I guess I made myself very clear on that. Okay, so I think, Kaushik, you said point number three. Point number three of the previous question, as I made a mention, that it would be same as the point number two. It'll be same as the point number two, because if you're saying that this loan is going to be repaid when Balram gets funds to repay, that means it's not repayable on demand, because you put a condition that you're going to repay when you get the funds. So point number two and point number three in this case would be treated similar. I think now let me just do a little consolidation of my inputs to you. I think I've given you a lot of things since morning, and I think this is the most important agenda. So I think let's consolidate this picture once again with you. Okay, I think Mani, you said difference will be a day one gain loss charge to the PL. That's absolutely correct. Okay, so moral of the story. So I think let me just consolidate the picture before we take this further. And I am just thinking, that we'll go through these questions and we won't fully solve them, but at least, give you the accounting entries at the inception. Thereafter, things are going to be very simple. Now, what is coming at the back of the mind is that when you are looking at the accounting of financial assets, you need to be clear on three important aspects. I'm just consolidating the three special issues relating to the accounting, which is going to be the most common frequency in the exam. You should be very clear about the treatment of TC. You should be very clear about the treatment of the processing fee. And you should be very clear about the difference in the transaction value and the fair value. So if I just take a very quick recap on these particular concepts, I would put it like this. If you're looking at the treatment in terms of the TC, my mind starts working on that. Are you looking at amortized cost accounting? Are you looking at FPTPL accounting? Are you looking at FPTOCI accounting, which is NR and a case of R? So very clear that if you're looking at a treatment of TC, in terms of AC, it is added to the financial asset, which leads to the triggering of the calculation of the new EIR. Similarly, in terms of FPTPL, it is immediately expensed in the profit and loss account. And if it is a case of OCI NR, it is again added to the financial asset value, and then it goes in the OCI at year end amount. But there is no such questions which are given regard to the annual transfer of things. So the most common thing which you're going to find in exams on a TC is the AC category. The most common things you're going to see is the AC category, where he will give you the transaction cost. You make adjustments to the financial asset value, trigger the EIR calculations, and done. Similarly, when it comes to the processing fees calculations, your mind should immediately think in terms of that this is going to be reduced in terms of the initial recognition. Processing fees will generally again relate to the AC category only, because if you're looking at loans, they will be financial assets which will be taken at amortized cost accounting, and this would also immediately trigger the need of EIR calculations. And then comes the concept of transaction value and a fair value. And in this particular case, I give you a three-step model to be applied. So when you're looking at a transaction value and a fair value, you just need to apply a three-step model. At the first instance, you need to see that if the contracted rate and the market rate is same, it's the end of the story, because the transaction value and fair value is same. No differences arises in the journal entry in that particular case. The second is if the contracted rate is less than the market rate, then there is a need to go to the step number 2. So you can very clearly see that the information on CR and MR will be given in the question. And then you need to see that the fair value is calculated based on what data. Is it observable or is it unobservable in nature? So if it is supposed to be observable in nature, then whatever difference arises in this entry is going to be taken immediately to the P&L. Gain or loss, whatever the case might be, is going to be taken in the P&L right away. But if it is case of unobservable data, then you need to go to the step number 3. And in terms of step number 3, you need to look at the type of relationship. And generally, you will find 3 kinds of relationships in the question. Either it's a case of employer-employee relationship, or it's a case of customer-supplier relationship, or it's a relationship of holding and subsidiary. So if you see employer-employee relationship, then in those particular cases, you need to take that as a prepaid staff cost. And that prepaid staff cost is going to be amortized over the period of the loan. And if it is a case of customer supplier, you're going to consider the difference as a right of use asset, which is going to be depreciated over the lease term. And if it is a case of a parent subsidiary relationship, then it becomes a deemed equity investment in the books of the parent company who gave this particular money. It becomes a deemed equity investment. That's it. So this is the crux of all the 3 special issues related to the financial asset accounting. These issues can be confronted in terms of the financial liability as well. And I think I've already given you the inputs that in terms of TC, for a financial liability, it gets reduced and triggers the calculation of EIR. And in terms of FPTPL, it goes to the P&L. But in terms of financial liability for a processing fee, it again gets reduced from the financial liability and triggers the need of EIR. As far as a difference in the transaction value and the fair value is concerned, this difference in terms of financial liability, you'll confront only in this case, where he would ask you the entries in the books of the subsidiary company. And I give you that in those cases, it becomes a deemed capital contribution in the books of the subsidiary. Right, so far so good. I guess I am pretty clear on my 3 special agendas, friends, so far. Right, I think you got a question. I think, let me just pick this up. Koshki said incremental borrowing rate means a market rate. Yes, the incremental borrowing rate would basically mean that he would, not be able to identify his internal rate of return. So he would pick up something, which is available on a similar transaction. So that's what is called an incremental borrowing rate. Right, friends. So I think now it's time to give you a break as well. I guess much needed indeed. So relax your mind. So I'm going to join you in 10 to 12 minutes time at the max. So let's take a break so far. And I'm going to join you back in some time. So take a break. So welcome back, friends. I guess you relaxed your mind as well. So now I think let's do some questions with you. Beginning with, I think, the very first question which I showed you. That's November 18 examination question. So I think let's have a look at how the entries would appear at the initial recognition. And of course, thereafter, the accounting of that financial asset or liability, as the case might be, would be, of course, done at an amortized cost accounting. So let me now read the entire question number 13 with you, which is a November 18 examination question. It says, N granted a loan of 120 lakhs to O for a period of 5 years at 10% per annum, which is a treasury bond YTM. But the incremental borrowing rate of O is 12%. In this case, the loan is granted to O at below market rate of interest. Ind AS 109 requires that a financial asset or financial liability is measured at a fair value at initial recognition. Should the transaction price be treated as a fair value? Of course not. If not, find out the fair value. And then it says, what is the accounting treatment of the difference between the transaction price and the fair value on initial recognition in the books of N? And be given the present value factors at the rate of 12%. So let's, I think, have a look at how we're going to do this November 18 examination question. So to begin with, first of all, what we need to do, you need to tell the examiner about the inputs that this is an off-market transaction. Given the information that the contracted rate is 10%, whereas the incremental borrowing rate, which is the market rate, is 12%, indicating that it's an off-market transaction. And then in this particular case, you could go and tell him that the fair valuation is based on observable data. And therefore, we are treating the difference as a day one gain or loss, as the case might be. So in this particular case, what you need to tell the examiner is the computation of the fair value. And as I said, when you're going to calculate the fair value of the financial asset, we need to consider the present value of all the future inflows, which will be discounted at the rate of 12% itself. So if you look at the contracted inflows, we can say that on 120 lakhs, you're going to get a 10% contracted rate, which is 12 lakh rupees. And this will be discounted at the rate of 12% for a period of 5 years. So the factors are already given to us. So we add 0.892, 797, 712, 636, and 567. That works out at 3.604. So this is one inflow which you're going to get at the end of each year. And then the principal amount will also be received at the end of the 5th year. And the factor is 0.567. So my fair value becomes the present value of all the contractual cash inflows discounted at the market rate of interest. And this becomes 120 lakhs into 0.567, 68.04. So this is, I think, coming to 111.288 lakhs. So this is the fair value of the financial asset to be recorded in the books of N. So now with this, we can do the entry. So in the books of N Limited, he would put the entry, the loan has been given, a financial asset gets created in the books of accounts. This will be at the fair value 111.288 lakhs. And the bank will be given a credit, and the bank will be given a credit to the extent of the transaction value, which is 120 lakh. And the difference in this particular case, as we said, is attributed to observable data. So we're going to call this as a day one loss. So this is going to be taken in the profit and loss account. The balancing figure is going to be taken in the P&L. That's a day one loss. So that works out at 8.712 lakhs is the balancing figure. That's a day one loss in the books of N. I guess pretty simple and straight indeed. So your presentation is going to be just based on the fact that you first tell the examiner that it's an off-market transaction. And then indicating that the fair value calculations are based on observable data. So we're going to call the difference in the transaction value and the fair value as a day one gain loss. Show the computations of the fair value and put the entry at the inception. Thereafter, making the loan account, which is a financial asset at amortized cost, is not going to be difficult. You just need to unwind the interest at the rate of 12%, and you keep receiving the contracted rate at the rate of 10%. So I think I'm not making the ledger account for the next 5 years. I guess that would be pretty simple and straight indeed. Okay, so this was the question number 13. I think now we can have a look at another question with you. And let's have a look at question number 14. It says on 1st April 2020, Star advanced a housing loan of 15 lakhs to one of its employee at the interest rate of 6% per annum, which is repayable in 5 equal annual installments along with interest at the end of. Now, sometimes, students tend to get a little confused on this part, especially when they're calculating the annual installment. They consider that the installment is equal and along with the interest. So they believe that it's supposed to be an equated annual installment. Well, I would say it's not an equated annual installment inclusive of interest. When 15 lakh rupees is being borrowed and it's repaid in equal installment, means 3 lakhs each, along with interest at the end of each year. So you're going to calculate 3 lakh as the principal repayment. And you're also going to calculate the amount of interest which will be paid at the end of each year separately. So it's not an equated annual installment inclusive of the interest. You can say it's an equated annual installment, which is only the principal portion is supposed to be equated. Then he says employee is not required to give any specific performance against that benefit. And the market rate of interest on a similar loan is 10%. So definitely off-market transaction. The accountant of the company recognized the loan in the balance sheet at an amount of 15 lakhs, which is the transaction value. The interest income is taken at a contracted rate in the P&L, which is 6% on 15 lakh. So he's done the initial recognition incorrect. He's recorded the accounting based on contracted rate, which is also incorrect. Analyze whether the above accounting treatment made by the accountant is in compliance with the relevant Ind AS. If not, advise the correct accounting treatment, interest and other expenses in the financial statement. So naturally, the other expenses would be in the form of that prepaid staff cost, which is to be amortized over the period of 5 years on a straight line. Along with the workings and applicable Ind AS, you're required to explain how the housing loan will be reflected in the Ind AS balance sheet as well. So I think at the first instance, we're going to again tell the examiner. So this is November 20 examination question. So at the first instance, again, when you start off the question, you need to tell the examiner that the contracted rate is supposed to be at the rate of 6%, whereas the market rate is 10%. So given the information on the contracted rate and the market rate, and given the information that it's an off-market transaction, then you need to tell him that the fair valuation is based on unobservable data. So we need to go to the step number 3, since it's based on unobservable data. And then if you look at the type of relationship, then you can indicate it's an employer-employee relationship. So any difference arising in the transaction value and the fair value is going to be treated as a prepaid staff cost. So first, apply the three-step model. Tell the examiner clearly in terms of how you're going to tackle the difference in the transaction value and the fair value, and then we can make the calculations of the fair value as well. Now, as far as the fair valuation is concerned, you'll have to make a list of contractual inflows for the next 5 years. So I think in this case, we'll have to make a chart, and we've got a period of 5 years in this case. So we need to consider the cash inflows, and we need to discount these cash inflows at the rate of interest, which is 10%. And based on that, we're going to get a present value as well. So I think I'm just going to quickly calculate these inputs to you. Now, as far as the cash inflow is concerned, the amount of 15 lakh is being recovered in 5 equal annual installments. So we can say it is 3 lakhs each. So 3 lakhs each is the inflow which you're going to get from the employee in terms of the principal recovery. And as far as the interest is concerned, the interest is going to be in the first year on 15 lakhs. You can say the entire 6% is outstanding. So 90,000 is the interest for the first year. And you can comfortably reduce this by 1/5 each year. So this will become 72, and this will become 54, and this will become 36, and this will become 18. Since the money is being repaid in 5 equal annual installments, the interest is going to reduce also 1/5 each year. Now apply the discounting factors at 10%, 0.909, then it's 0.826, 0.751, 0.683, and 0.621. And if you calculate the present value, this is going to give you the fair value. So I think without getting into the nitty-gritties at this stage, the employer will put the entry in the books, loan will be given a debit, and this will be at the fair value which you have calculated above. The bank is going to be given a credit, which is the transaction value, which is 15 lakhs in this case. And then you're going to get a balancing figure in this particular case. And the balancing figure is what we can say is the prepaid staff cost. The balancing figure is going to be the prepaid staff cost in this case, which is going to be amortized on a straight line basis for the next 5 years. So in the profit and loss account of the company, if you were to reflect the position in the profit and loss statement and the position in terms of the balance sheet, in the profit and loss account, there will be number one, a finance income, which is arising on the staff loan. Then secondly, there will be a staff cost amortization as an expense in the profit and loss account. So these are the two items we're going to put in the P&L account every year, the unwinding of finance income and the staff cost, which will be amortized straight line. In the balance sheet, the loan would appear in the balance sheet, and that will be split in terms of the non-current and the current portion. The portion which is payable within a period of 1 year will have to be segregated in terms of a current liability, and the rest of the portion is going to be reflected as a non-current. So when you're going to show the presentation in the balance sheet, be a little careful that this particular loan is going to be reflected in 2 different components. The portion which is payable within 1 year is current, and the portion which is payable beyond 1 year is going to be non-current in nature. So I think I'm not making the ledger account for the next years. The loan account is going to be prepared at an amortized cost accounting, the usual way. So I think I'm going to skip that portion to you. Right? I guess we are comfortable on this. Okay, I think I've got a question. Koshki said, in question number 13, how the fair value was based on a level 3 observable inputs. It is only the contracted rate which is based on level 2 observable input. I can't understand that. Okay, let me put that once again to you. Well, in terms of question number 13, we are very clearly given that N granted a loan. And when he granted a loan, was the interest rate, calculated based on observable input? Let's put that question to you. When N granted a loan to O, so did he decide a rate of interest which is based on an observable input? So when you're going to consider the interest inflow and the principal inflow, so all these inflows are based on observable data, which is the YTM of the bond. If you say a yes, then I think I can now say that since observable inputs have been taken in the fair valuation, it becomes a clear-cut case of taking it as a day one gain loss. Am I clear? So I'm putting it once again. If you look at the question number 13, the inflows on the basis of which you're going to calculate the fair value is based on a treasury bond rate. So since the inflows for the purpose of the fair value calculation is based on a treasury bond YTM, you can say it is observable data. And therefore, since the fair valuation is based on observable data, it becomes a case of day one gain loss. On the other hand, if you look at the question number 14, the company Star Limited just decided to charge a 6% interest rate. And in this case, you can't really say that there will be any observable market on the basis of which the 6% rate must have been decided. So when you go to consider the fair value based on 6% interest which you're receiving, is that 6% interest inflow for the purpose of fair valuation based on observable data? I would say no. So when you calculate a fair value, which is based on the present value of the inflows for an asset or the present value of the outflows for a liability, the inflows and the outflow should be based on, you can say, observable input. So in question number 13, it is based on a YTM of a bond. But in terms of question number 14 and other questions, it is based on, you can say, just a rate, which the company decided on its own. It's not based on any data. So we can say it is unobservable in nature. It's supposed to be, management estimated that let's charge the employee a 6% rate, right? I guess I am clear with that point, I guess. Okay, so I think we are done with the question number 14 with you. And I am not taking this question further in terms of subsequent accounting. Similarly, let's have a look at the question number 16, though the computations are going to be exactly on the same lines. But I think at least let's give you the initial accounting on this. Okay, I didn't get any inputs from you, Koshki. I think, did you get your answers or not? Okay, so yet to receive any inputs at your end. If not, do ask me again. Now let's go to the next question with you, which is question number 16, November 19 examination question. It says A made a security deposit and the details are given. We require to make journal entries and we given the market rate is 12%. There is no contracted rate which is given. So in this particular case, the only inflows which you're going to get is the security deposit principal money back. So here again, in question number 16 in November 19, we can again, first of all, tell the examiner the information that the contracted rate is 0 and the market rate of interest in this case is 12%. And we can say it indicates it's an off-market transaction. And we are considering the fair value based on unobservable data. So in this particular case, we go to the step number 3. And when I go to the step number 3, we need to consider that in this case, it's a relationship between a customer and a supplier. So the difference is going to be treated as an ROU asset in the books of accounts to be depreciated over a lease term. Okay, so with this, now we need to first of all calculate a fair value of that deposit as well. So let me calculate the fair value of this deposit. So the fair value is going to be based on the present value of all the future inflows. We are not getting any interest. The only money we are receiving is the principal money is being received at the end of the 5th year. So we just take the principal money of 10 lakh discounted at 0.567427, 0.567427, and this will give us the fair value of this particular deposit. So 0.567427 into 10 lakh, this works out at 567,427. So if I were to pass an entry at the very inception, we can put the entry security deposit gets a debit, which is to the extent of fair value 567,427. And the bank gets a credit to the extent of the transaction value, and we take the balancing figure, and this balancing figure is nothing but we're going to call it as a ROU asset. And this is the balancing figure to be depreciated over a period of 5 years. So that works out at 432,573. That is the balancing figure. That is the right of use asset. Thereafter, the accounting for the security deposit is going to be done absolutely in the same manner. You're going to do the amortized cost accounting and do the unwinding. So everything remains exactly similar as we've done earlier. Okay, so this part is done. And now I think we can make a walkthrough in terms of another relationship as well. And I think let's have a look at the question number 19, which is a May 18 examination question where you've got a holding subsidiary relationship. So we're given that S issued redeemable preference shares to the holding company H, and the terms of the instrument is summarized as below. The loan is for a period of 3 years, and the preference shares issued is to the extent of 500 lakhs. The dividend rate is practically 0.0001% is as good as zero, and the market rate of interest is 12%. So we can again give the inputs to the examiner. I'm doing it a little faster because I think this doesn't need much inputs to be explained. So I'm just quickly, doing my workings, because all you need to do is just do the calculations. So you tell the examiner contracted rate is again nil, and the market rate of interest is to the extent of 12%. So this is again an off-market transaction. And then again, you tell the examiner about the fair value is based on unobservable data. And you go to the step number 3. And in terms of step number 3, it's a holding and a subsidiary relationship. So what do we call this difference as? This is a deemed equity investments in the books of the parent. So this becomes a deemed equity investment in the books of the parent company. So again, we're going to show the calculations on the fair value and do the entry. So let's do the calculations of the fair value based on the present value of the inflows. And the only inflow which is coming in is the principal money, that is 500 lakhs at the end of 3 years. So we get 500 lakhs as the principal amount which you receive at the end of third year. So at 12%, we get the present value factor at the end of third year. That's 0.7. No, I think the factor is already given. No, it's a little misprint. It's 0.7118. It's 0.7118 is the present value factor at the end of third year. So 500 lakhs into 0.7118, this works out at 355.9 lakhs is the fair value. So the entry which you're going to do at the inception is going to be, you made investment in the preference shares of the subsidiary. So the entry becomes investment in preference shares will be given a debit. And this will be the fair value 355.9. The bank will be given a credit to the extent of the transaction value, which is 500 lakhs. And then you take the balancing figure. This is a deemed equity investment. This is a deemed equity investment as a balancing figure. And this is going to be 144.1. So that becomes a balancing figure. That is a deemed equity investment. So I think pretty simple and straight. Once you're able to identify that, this is a case where we are going to step number 3, you identify the relationship. The financial asset gets recorded at a fair value. The bank gets a credit at a transaction value, and any difference depending upon the relationship gets recorded either as a deemed equity investment or a right of use asset or a case of a prepaid staff cost, as the case may be. Right, I guess so far so good. I guess we are quite comfortable with the concept, I guess. Okay. Now I am going to take you to a little interesting chart, because I think before I move on to the financial liability concept, I think I want to make a simple little chart giving you the inputs of all the agendas relating to financial assets. So I think it's going to be a good idea, I guess. So let me do one thing. Let me just make a consolidated chart to you, which will summarize the position for all categories of financial assets. What is done at the initial recognition, what is done at the subsequent accounting, processing fee, TC, everything put together. Just that I'm not going to consider the concept of transaction value and fair value, because that's a separate 3-step model. So let's do one thing. Let me now make a very interesting chart to you. So please do copy this chart. Let's add on every issue in this. Then I'll go to the concept of financial liabilities with you. So I'm looking at a chart in terms of financial asset, and I'm looking at the 4 categories: amortized cost, then I'm looking at FVTPL, then I'm looking at FVTOCI, there is no recycling, and I'm looking at FVTOCI, there is recycling. So let me summarize the movements to you. So be very careful as I fill this chart, because I'm going to consolidate all the learnings we have developed on financial assets so far. starting from the concept of the based on classification. Now, first of all, I'm looking at that there is a debt investment, or there is an equity investment, or there is a case of a derivative investment. That links my very first chart, which I gave you when we were looking at a classification of financial assets. So I'm looking in terms of debt investments, equity investments, and derivative investments. Debt investments can be measured at AC. Debt investments can be measured at FVTPL, but debt investments can never be measured at NR. And the debt investments can be measured at R. So a debt investments could take any of these three categories except FPD, OCI, no recycling. Equity investments is never measured at AC. It can be measured at FPTPL. It can be measured at FPD, OCI, NR, but it's never measured at FPD, OCI, R. Next, derivative investments can only be measured at FPTPL. No other category is applicable. So I guess the first phase is very clear. Your derivative investments are going to be measured at FVTPL. Your equity investments is measured either at FVTPL or FPD-OCI. And I think at this stage, it is worth making a mention as well that when you look at equity investments, this is the default category. If you look at a derivative, this is a default category. And if you look at a debt investments, I would say it all depends upon if the debt investments is a financial liability for the issuer, then the default category is AC. And if the debt investments is a compound financial instruments for the issuer, then it becomes FPTPL default category. I hope you're able to catch up with my first point very clear. That when you're looking at a derivative investments, the default is FPTPL. If you're looking at equity investments, the default is FPTPL. If you're looking at debt investments, if it is a financial liability for the issuer, it is AC, default. And if it is a compound financial instruments, then it is FPTPL, phase one. Next. Then I went ahead and went to the concept of measurement. And in terms of the measurement, we decided something in terms of initial measurement. Now, in terms of initial measurement, we've got some more inputs available with us, and that is that you record it at a fair value and plus a TC, and can I say minus a processing fee? Wow. Go through this very carefully. When it is a category of AC, you consider the fair value plus the TC minus the processing fee. And the moment you do these things, it immediately triggers the need of calculating a new EIR as well. And in terms of FPTPL, it's just the fair value. The TC is supposed to be taken in the profit and loss account immediately. And as far as processing fee is concerned, typically relates to AC. In FPD OCI as well, it is fair value plus the TC. I'm not considering the processing fee because the processing fee typically will relate to AC category. And even in this case, it is a fair value plus a TC as well. Okay, now let me tell you something more, which I didn't tell you earlier, but I think let me add on something more at this particular stage. I'm talking of OCIR. I'm talking of OCIR since it relates to a debt investment. Hear me carefully, friends. Since it relates to a debt investments, the moment you're going to add this TC, even in this case, a new EIR calculations will be required. Though you will not see a question available on this category, but let me, I think, pinpoint that the calculations of EIR is relevant also in a category when it is OCI-NR. Because OCI-NR relates to a debt investments. So in this particular case also, the moment you're going to add a TC, it will trigger the calculations of EIR. There is no concept of EIR applied to FPTPL. There is no concept of EIR which is applied to OCI-NR. The concept of effective interest rate is applicable to AC and is applicable to OCIR. In these two cases, the moment you make adjustments to the TC, there is a need to calculate a new effective interest rate as well. Okay, then we move on to the subsequent accounting as well. And in terms of subsequent accounting, I am now looking at, do we pick up the fair value changes or not? So do we pick up the fair value changes or not? In terms of AC, no. We do not consider any fair value changes subsequently in the books of accounts. In case of FPTPL, yes, and it is taken in the profit and loss. In case of OCI, yes, and it is taken to the other comprehensive income. Even in OCIR, it is yes, it is taken to the other comprehensive income, except that this amount of OCI relates to the point number 14A, if you remember, and this relates to point number 14B, if you remember. You're going to put this in the other comprehensive income section, and this will be 14A or B, as the case might be. So we need to be careful that in which cases the fair value changes will be considered or not. This is on the subsequent and the initial measurements. Now, some more points further to be added. Now, other things is that if you receive any interest or if you receive any dividends on these particular investments, where do you take them? In terms of AC, it is taken to the P&L. In terms of FPTPL, also to the P&L. In terms of OCI, also to the P&L. If there is any interest or dividends, mind you, if there is any interest or dividends received on any of these investments, everything P&L. Remember, the concept of OCI relates to only the fair value changes to be taken to the OCI. It does not mean that other things are going to be taken in the OCI. Any returns in the form of interest and dividends will be taken in the profit and loss for all categories. Next. Now, let's say if you make a sale of these investments, so what happens to the profit or loss on sale of these investments? So when the investment is going to be sold in terms of AC, the profit and loss will enter the P&L. In terms of FPTPL, it will also enter the P&L. In terms of OCI NR, it's going to be taken in the OCI, not in the P&L. We're not going to consider the profit and loss in terms of the profit and loss. It's going to enter in the OCI. And in this case also, it's going to be taken in the P&L. Because many times students do get a confusion that, when you are considering the profit or loss on sale, where do you take it? The profit or loss on sale, if it relates to NR, is taken to OCI. Rest all the cases, it is taken to P&L. Now, another wonderful aspect. Now, there is a concept of impairment. The question arises that which particular financial asset is subject to impairment testing or not, which we'll discuss when we come to the category of impairment. But let me tell you in advance. If you measure the financial asset at AC, impairment testing is applicable. If you measure at FPTPL, impairment testing is not applicable. If you consider OCI NR, then also impairment testing not applicable. Not applicable. But if you consider FPT OCI R, it is applicable. Since there is a concept of no recycling, I think I made a mention earlier as well, the impairment testing in terms of equity investments never applies because we cannot afford to put anything in the profit and loss account. But in terms of OCIR, there is an impairment testing, which means one thing I like to pinpoint at this stage, slightly technical, but I think I want to say that. Now, please appreciate this very carefully, what I'm about to tell you in terms of OCI, that is recycling. Many people have got the concept that OCI recycling means that the accumulated amount in OCI, which is accumulated in SOCI, will be taken to the P&L at the time of derecognition of the financial assets. I put it again. Many people tend to believe that in terms of OCI recycling, the accumulated amount which is there in SOCI in tab number 3 is going to be recycled to the profit and loss account. But I would say there are certain items which need an annual transfer. There are certain items which need an annual transfer. One is the transaction cost. Because at the end of the first year, you took the change in the fair value in the OCI, and even the transaction cost went into the OCI. So there will be a need to transfer an annual amount related to TC in the profit and loss account. Secondly, the fair value changes enters the amount of OCI at the end of the year. So even the impairment loss is to be recycled and put it to the P&L at the end of the year. This is what we're going to see in the context of impairment. When I'm going to go to the concept of impairment towards the end of this standard, there is a very important, a very good illustration which is given, I think, one of the RTP questions, which throws a light that the fair value change in OCI went into the other comprehensive income, but then a portion of that fair value decline, which is attributed to impairment loss, has to be taken to the profit and loss account. So it's not that we wait for the derecognition of the financial assets. In terms of OCI, there is an annual transfer of a transaction cost in the P&L. There is a transfer of the impairment loss also to the P&L. So this is one thing which I wanted to pinpoint carefully. Right, so this takes care of my comprehensive movements in terms of the financial assets from the classification concept to the measurement concept and to the concept of what do you deal with the interest, dividends, the profit on sale, and the impairment aspects. I know it must be getting quite heavy indeed, but I hope I've made myself very clear on the agenda. I hope I've made myself very clear on the agenda. Okay. Now I am going to take you to the next aspect, and that is financial liabilities with you. The focus so far has been on financial assets. Now I'm going to change my focus in terms of financial liabilities. So let's begin the journey in terms of financial liabilities with you. Now, as I said earlier as well, but I am now going to consider a few more inputs to you at this stage, because this will give me a background in terms of what I'm going to discuss in the next class as well. When you look at the concept of financial liabilities, per se, there are only two categories of financial liability. One is that it is measured at AC, and one is that it is measured at FVTPL. But I think in the previous class also, I had given you some more inputs, and I said that financial liabilities can also be another three categories. So you can say, in effect, there are 5 categories of financial liability, but we are concentrating only on these 2 at the moment. But let me just remind you the other 3 as well. So either the financial liability is taken at amortized cost, and this is supposed to be the default category. This is supposed to be the default category. All the financial liabilities are measured at AC, unless mentioned otherwise. The FVTPL applies only if it is a derivative financial liability, or if you say that it is a short-term profit-making objective. So if it is a short-term profit-making objective, or if it is supposed to be a derivative, then it's taken at FVTPL. Now, coming to the other 3 kinds of financial liability, and the other 3 is, one is what I said, a contingent consideration. When a company acquires business of another company, as a part of the purchase consideration, there could be certain contingent consideration also which could be paid. This contingent consideration is measured at a fair value initially and is subsequently treated as a financial liability measured at FVTPL. I repeat, when as a part of the business combination, a company pays a purchase consideration which is contingent upon the fulfillment of certain conditions, it is initially taken at a fair value and it is subsequently accounted at a fair value through P&L. We are not covering this financial liability out here. This is what you're going to cover in terms of Ind AS 103 in business combination. You're going to see an extensive treatment of this kind of financial liability. How is it treated initially and subsequently? And let me tell you, this treatment could slightly vary depending upon, you'll see all those detail, the connect in terms of Ind AS 109 and Ind AS 103. You're going to see that later. This is another financial liability. Next, There is another financial liability, which I said is a case of a financial guarantee. And we're going to tackle this separately as a separate discussion. We'll talk about the AC and the FPTPL, but this will do a specific discussion with you. One of the very interesting questions came in the RTP, and I think it's come twice in terms of financial guarantee accounting. So this financial guarantee is also recorded at a fair value, but subsequently there is something to be done. I'm not saying that it'll be taken at a fair value through P&L. You can say that, but we need to do some measurements. We'll talk of this separately. Then there is another very interesting financial liability. And this financial liability gets created when financial asset cannot be derecognized. When the financial assets cannot be derecognized. Now, what do you mean by that a financial asset cannot be derecognized? Let me take a small little example to illustrate this to you. Let's say, for example, I go to the bank and get my bill discounted. Ordinarily, what you studied in school, what you studied in your intermediate level is that if you go to the bank and get a bill discounted, the entry is supposed to be bank account debit and bill of exchange gets a credit. And if there is any discounting charges, you take it to the P&L account. So any discounting charges are taken in the P&L. This is the entry which we do at the time of discounting a bill of exchange. But trust me, this entry as per Ind AS is not correct. We'll see the logics when we come to the concept of derecognition of financial assets with you. But for the time being, let me tell you that if you get a bill discounted from a bank, you cannot derecognize, you cannot remove the bill receivable from the books of accounts. Rather, if you've got money from the bank on discounting the bill, you should put the entry bank account debit and financial liability should be given a credit. Instead of removing the bill receivable from the books of accounts, you need to recognize a financial liability in the books of accounts. And this is called that creating a financial liability when a financial asset is not eligible for derecognition. Discounting a bill of exchange does not allow you to derecognize a bill of exchange from the books of accounts. So we can say that the derecognition of financial asset is not eligible. Therefore, there is a need to recognize a financial liability. So this kind of financial liability, we'll see when we come to the derecognition concept, but this will be accounted using amortized cost accounting. So I would say when you're looking at the concept of a financial liability, just keep your inputs in terms of two parts. One is you can say that there are two ways a financial liability is measured. One is AC, which is a default category, and one is a derivative which is taken at FPTPL. And then you can take special issues in terms of financial liability, contingent consideration dealt in 103. And then there is supposed to be financial guarantee. We'll take it as a special case of discussion with you. And then there are certain financial liabilities which are created because a financial asset cannot be derecognized, like discounting a bill of exchange. You cannot derecognize a financial asset. So therefore, you need to recognize a financial liability for the consideration received on discounting the bill of exchange. And that is supposed to be measured at AC. Right. So this was one inputs to be given to you. Now, let's, I think, quickly also map up the treatment of the TC and the processing fee as well before it disturbs us. Though I've already given you the inputs, but I want to do it very safely again at this end. So I'm looking at the financial liability treatment, and I'm considering that if you measure AC or if you follow FPTPL, in this particular cases, I want to understand the treatment of TC and I want to understand the treatment of processing fee. So let's have a quick recap in terms of what we discussed already, that in specific to financial liability, what is the treatment? Can I say if the financial liability is measured at AC, what do you need to do? You need to reduce the TC from the initial recognition. So you're going to consider the initial recognition at fair value minus the transaction cost. And immediately as you do this, you know what should trigger in your mind. The moment you adjust the fair value at initial recognition, there is a need to calculate a new effective interest rate as well. Even in terms of processing fee, if you consider this is again going to be reduced from the financial liability value itself. So from the fair value, you're going to reduce the processing fees which you receive at time zero. And immediately as you do this as well, it triggers the need of calculating the effective interest rate as well. So the moment you do this particular entry, you make a reduction of the TC or you make a reduction of the processing fee, it immediately triggers the need of calculating the new effective rate of interest. TC for FVTPL is going to be taken immediately to the profit and loss account itself. And I would say processing fee is not going to be applicable for a financial liability. Because if you've got a financial liability in the form of a bank loan you've taken, then I think it would be more appropriate that it would be measured at amortized cost accounting. So I think the concept of TC and the concept of processing fee gets taken care itself. And then if you remember in terms of transaction value and of fair value differences, I think I've already given you the inputs that in terms of transaction value and fair value differences, you'll typically see the subsidiary equation, and in the subsidiary equation, what we're going to do, we're going to treat this as a deemed equity investment. So I think let me make a mention out here. So typically, if you look at the case where a transaction value and a fair value differences will arise, you will see generally one kind of question coming to you. And that is the case when there is a holding subsidiary relationship. So what the subsidiary company will do, that it first of all, receive the money from the parent company, and this will be transaction value. And then the company must have issued, let's say, preference shares in the same example. So you issued preference shares to the parent company. So this will be the fair value. So we're going to get a balancing figure in this entry. And that balancing figure is what we can say deemed capital contribution. This is going to be a deemed capital contribution going to record in the entry. So typically he would ask you this. So I just kept one question pending, and I think I'll now take you to that particular question itself, which was tackling with the books of the parent and the subsidiary, the loan recoverable payable on demand. Right. So this was a nutshell treatment in terms of financial liabilities calculations. I think let me also remind you another thing as well. If you're looking at a financial liability taken at AC, we don't need to consider any fair value changes, just like asset. But if it is taken at FVTPL, we need to record the fair value changes as well. Okay, so let's now, I think, take you to that particular question, loan payable on demand. Let me just come to the question out here. That was question number 21. So let's have a look at the question number 21 now. It says RAM is a company incorporated in India and it provides 25 lakhs interest-free loan to its subsidiary Balram. The parent company gave a loan to the subsidiary company and there is no TC. How should it be accounted in reference to Ind AS in the books of RAM, in the books of Balram, and in the books of consolidated financials, considering the following scenario? So the first case we are taking that it's a repayable on demand, and the second one we are considering it's a 3-year loan and the current rate is 12%. Now friends, watch me very carefully on this December 21 question. Let me just come back and watch me on this. So I am looking at the December 21 examination question. This is the books of the holding company. This is the books of the subsidiary company. And this is the consolidated financials. He's asking you the treatment in the books of parent, in the books of subsidiary, and in the consolidated financials. So this is like the separate financial statements of the parent. And this is the consolidated financials, and this is also the standalone financial statements of the subsidiary. Now let's consider the case that the loan is payable on and recoverable on demand. Now I'm going to give the entries, watch me carefully. If the loan is recoverable or is payable on demand, then the concept of transaction value and fair value is not applicable. The parent company will put the entry, loan will be given a debit, bank will be given a credit. Can I outrightly say this will be recorded at 25 lakh rupees itself? the transaction value and the fair value is going to be taken. So 25 lakh is the loan amount. So we just put the entry FA to bank. Done. Subsidiary company will put the entry bank account debit, and the loan, which is a financial liability, will be given a credit, and this will also be taken at 25 lakh rupees itself. So this is the entry which the parent and the subsidiary will do when they are making their separate and standalone financial statements. Can I say in the consolidated financial statements, the loan will get cancelled as an intercompany owing. There is a loan payable and there is a loan recoverable on the asset and liability side. So it will cancel as an intercompany owing. So nothing gets reflected in the consolidation because it's a loan between the parent and subsidiary. So asset on one side, liability on one side, it gets cancelled, the end of the story. Right. Now let's consider the second case. Now, in the second case, when I say that the loan is not recoverable or payable on demand, it's a 3-year loan. It's a 3-year loan. Now, let's see the entries which we will pass in the books of parent and in the books of subsidiary and in the consolidation. Can I say now the parent will put the entry, loan will be given a debit and the bank will be given a credit. And can I say loan will be given a debit at a fair value? Can I say the fair value is going to be what? Rupees is going to be recoverable at the end of 3 years. So discounted at 12%, 0.7118. So you would record this at 25 lakhs into 0.7118. That is recorded at a fair value. And can I say bank will be given a credit to the extent of the transaction value, that is 25 lakhs. And what is the difference I'm going to put in this entry? In the books of parent company, it is supposed to be a deemed equity investment. So we can call this as a deemed equity investment. This is going to be called as a deemed equity investment in the books of the parent company. Now, if you look at from the subsidiary's point of view, can I say he would put the entry bank account debit, and bank will be given a debit to the extent of the transaction value, that is 25 lakhs. The loan, which is a financial liability, will be given a credit, which is equal to the fair value, which is again 25 lakhs into 0.7118. And where do you take the difference in the books of accounts? Can I say the difference is going to be a deemed capital contribution? Is going to be a deemed capital contribution in the credit side of the entry. That's the balancing figure. So the company is going to put a deemed equity investment. So he puts a deemed equity investment and he puts a deemed capital contribution in the credit side of the entry. And if you look at things from the point of view of the consolidated financial statements, it's again a recoverable and a payable on the asset and liability side. So this will again cancel as an intercompany owings itself. So automatically it gets cancelled and nothing would appear in the consolidated financial statements. Wow. So I think now we are done with the treatment of all these permutation combinations, including the loan recoverable payable on demand. Now, before we end, I think I'm just going to show you a few questions in the study mat on the financial liability, which you can try, and then we can give you some MCQs to try as well. So let me just come back now to the study material, which is on the unit number 2. Now, there are a few questions which you can definitely try on your own. So on the financial assets in the unit 2 of the study mat, we've already covered the illustration number 22 with you. And you can have a look at illustration 23. And I guess illustration 24 I've already covered earlier with you. Illustration 25 I've just covered with you, security deposit one. Then illustration 26 I did in the previous class with you. Then illustration 27 also I did in the previous class with you. And now you can consider the illustration 28, which is a loan between the parent and the subsidiary, quite similar to what we have done just now. So illustration 28 you can definitely do. And you will see The treatment similar to what we have done, illustration 28. And now comes the financial liabilities, and financial liabilities, I think I'm going to take you to the measurement aspect. So this is one illustration which you can try. Let me just read this illustration to you, but you need to be a little careful in terms of this illustration because the interesting part is to calculate the EIR. It says A made a borrowing from RBC Bank at 10,000 at a fixed interest rate of 10%, and there is a processing fee. Aha. The moment you see that there is a processing fee, what immediately comes to the mind is that you need to make a reduction to the value of financial liability. So your financial liability at initial recognition will be taken at 9,500 because 10,000 minus the processing fee, and that would immediately trigger the need of calculating the EIR as well. I will not be able to consider the 10% rate of interest, but you'll have to consider the effective interest rate in this case. The loan is repayable after 5 years in bullet repayment. And now you need to be careful that in this case, the interest is charged and paid yearly. And there is an upfront fees. So in this particular case, the upfront fees is nothing, but it is the processing fees itself. So all you need to do in this particular case, you need to get your effective interest rate and then apply the amortized cost accounting. So I think I'm leaving this illustration for practice to you. Do try this illustration number 31. And a similar kind of illustration is given, that is 32, which is a little interesting because in this case, the annual payments are not there. In this particular case, the loan is being repaid in half-yearly installments. And if it is going to be half-yearly installments, you will get a little challenge in terms of calculating your effective interest rate as well. But I think the challenge is being reduced because immediately, as you see in the requirement of the question, we are given the internal rate of return. But I would advise, if you want to make your concepts even more stronger, then what you can do in this illustration, you can try to calculate the internal rate of return on your own. Let's consider that if you collect the processing fees and there is a 4 half-yearly installments, try if you can derive this IRR. But with this IRR already given, I think life is simple. Making a ledger account will not be difficult at all. Right, friends. So these are a few questions which you can try and look at 33, 34 as well. So what I am now going to do, give you some MCQ questions to try based on our learnings today. And in the next class, I'll be concentrating on the accounting for financial guarantees in typical. And then I think my main focus will be on the derecognition of financial assets and liability. So I'm going to pick up the financial guarantee accounting and then go to the derecognition concept. And thereafter, you know that we've got 3-4 special agendas to be discussed: the embedded derivatives, the impairment, and the hedge accounting. So more or less, I think in the last classes, last 1 or 2 classes, we'll be doing those special issues with you. But next class, definitely derecognition concepts will follow. So I think first, let's give you some MCQs for trying based on the thoughts today. Let's give you the MCQs. You can note it down, and I'll give you the answers in the next class, though you can try them right away. So I am first giving you a treatment in terms of processing fee. Can I say processing fee, whether it relates to a FA or it relates to an FL? It is always reduced at initial recognition. It is always reduced at initial recognition. This is the treatment, and it also triggers the calculation of the new EIR. So when I'm looking at a processing fee, I'm saying the processing fee in terms of financial asset or financial liability is always reduced from the fair value recognition. Number 2. So we're now considering that if your fair value is based on unobservable data, if the fair value is based on unobservable data, and I identify that there is a holding subsidiary relationship, and I identify that there is a holding subsidiary relationship in the books of the parent company, there is going to be a deemed equity investments. There is going to be a deemed equity investments, and in the books of the subsidiary, there is going to be a deemed capital contribution. There is going to be a deemed capital contribution. So I've given you the treatment with reference to both the books of accounts, the parent and the subsidiary. So if your fair value is based on unobservable inputs, then a deemed equity investment in the books of parent and deemed capital contribution in the books of subsidiary. Number 3. So if you're saying that the fair value is based on observable data, if the fair value is based on observable data, then in this particular case, we call it as a day one gain, or we call it as a day one loss. We call it as a day one gain or a day one loss. Next, number 4. Can I say when we're looking at a fair value based on unobservable data, when you're looking at the concept of fair value on the unobservable data, and there is an employer-employee relationship, there is an unobservable calculation and there is an employer-employee relationship, then we treat this as an expense immediately. We treat the difference in the transaction value and the fair value, and it is taken to the P&L immediately in this particular case. And finally, let's give you the point number 5 as well. So I think the fair value relationships done, then I think processing fee is done. Then I think the last and the typical one, which we can give you. And we can say that as far as not a fair value, I want to give you a different question. We can consider something from the previous background as well. So can I say as far as a TC is concerned, whether it relates to FA or whether it relates to FL, can I say in this particular case, when I follow AC or when I follow FPT OCIR? Mind it carefully, interesting question. When you consider a TC and there is a financial asset or liability, whether it's taken at AC or OCIR, financial assets, OCI will be applicable, liability it's not applicable. Can I say it triggers a new EIR calculation? So EIR calculations will get triggered in both the cases, whether it's a case of AC, whether it's a case of OCIR. So financial assets, both categories are applicable, but liabilities only, the AC category is applicable. I guess that seems to be quite a good, interesting 5 MCQs to you. And I think I'm already started getting answers on that. Okay, I think we are getting answers. The first 2, 3 is true, 4th is a false, and the 5th one is true. That's right, Rashmi, wonderful indeed. Okay, brilliant indeed. So I think this puts us a little testing as well. I'll share the answers of these questions to you in the next class, but please keep revising. And my piece of advice is that financial instrument, requires a cumulative kind of revision. When you revise the first class, then you go to the second class, revise the first and the second. When you go to the third class, revise the first, second, and the third. Because as you progress, ahead of this particular standard, the missing link in terms of the previous part also gets connected. So maybe, since you've got a Sunday morning weekend with you, you could do a little cumulative revisions to yourself. Do a little good practice also. So I'm going to catch you in the next class, where we're going to start with the financial guarantee accounting, followed by the concept of derecognitions to you. So let's see if you've got any further questions to ask. Otherwise, I think we're going to call it a day. Thank you, Manini. Thank you, all of you. So I think there seems to be no further questions coming in. Okay, then I think it's time to bid goodbye, friends, to you. So I'm going to see you in the next class. Till then, thank you, take care, and bye-bye.